Now friends, we have completed the chapter of capital structure. We'll now be taking up the next chapter, that is the chapter of cost of capital. Now this chapter of cost of capital is important for three reasons. One, you will find sums in the exams on this chapter, practical sums. You can even be asked theory out of this chapter, and the relevance of this chapter you will get it also in final CA level. So important chapter, interesting as well, and a lengthy chapter amongst all the other chapters as well. So I would say let's discuss the chapter of cost of capital. Now, by this time at least you would have realized the strategy which I follow is what? We would first discuss meaning of the chapter, then we would discuss the objective. So we have meaning that needs to be discussed, and we will discuss the objective. Now, first let's focus on the meaning. Friends, what do we understand by the word capital? Now, every chapter you realize that some or the other way we are discussing the term capital. What is capital? Capital is actually nothing but money that is required to start or to run the business. So capital is what? Money needed, money required to start or to run the business. Now the money that is required to start or to run the business, do we raise it from long-term sources or is it raised from short-term sources? Now many people would then say, sir, short-term sources. But usually that's not the case. We will always be raising money from long-term sources. You know why? If you raise money from short-term sources, the problem will be you might not even start your business and your repayment obligations would arise. So you definitely prefer, long-term sources of finance. So in this chapter, my dear friends, the word capital is the one that is going to be from long-term sources. So here the word capital is that which we will be raising from long-term sources and not from short-term sources, which means short-term sources of finance are completely excluded from our discussion. These are only long-term sources, and the examples I would say would be equity share capital, we have preference share capital, and we have the debt and so on. Now, so we have the long-term sources of finance. So the word capital is nothing but money that is required to start or run the business. Now, what do you understand by the word cost? How would you define the term cost? Let me explain you this way. The minimum returns expected by the investors on their investments. Please understand the wordings. The minimum returns expected by the investors on their investments is profits to the investors and is cost of capital to the company. Simple. I will again repeat. The minimum returns expected by the investors on their investment is profits to the investors and is cost to the company. See friends, it's a simple thing. It's always a zero-sum game. What is gain to you is loss to me. What is profits to you is cost to me. If I give you an example, suppose you are an owner of a property. You are the landlord of that property, and I want that property on rent. So what will I do? We'll enter into rental agreement whereby I will pay you periodic consideration by way of rent. This rent for you will be an income. It is a gain to you, but can I say that is same loss or cost to me? So what is gain to someone has to be loss to the other. What is profit to someone has to be cost to the other. So the minimum returns which you expect on your investment is returns to you, but it is cost to me. That's the meaning of the term cost. Now, what's the objective of this chapter? Why do we have this chapter in our syllabus? What message or what knowledge we will gain out of learning this chapter? To better understand this, let me straight away start with an example. For the entire part of our discussion, you guys are going to be the investors and I'm going to be the finance manager of your company. Now, let's understand why this chapter. Now, there is one awesome business proposal that has come across. There's an opportunity that I wish to capitalize. एकदम awesome business एक आया है. But वो business में पैसे invest करने के लिए पैसों की जरूरत है. And me being finance manager, I will never invest my money. I am the finance manager. I will never invest my money. But I will come across to you guys. You guys filthy rich people, investors. I come across to you and I tell you, अरे यार awesome business है यार. अपने को तो वो business पक्का start करना चाहिए. तो आप लोगों ने पूछा, ठीक है, कितना पैसा चाहिए? तो I said, मैंने मेरा रिसर्च किया और मुझे पता चला कि ये बिजनेस के लिए हमको टोटल 10 लाख रुपीस लगेगा. This is what I require. So are you guys willing to invest? You said, of course, we are investors. We will invest. So what will I do? I will now collect 10 lakh rupees from you guys. That 10 lakh rupees that you are going to give me, if I think from your point of view, for you, it is an investment. But for me, can I say that same 10 lakh becomes a capital, money. So that capital, I will be considering it here of rupees 10 lakh. Now, when you gave me this 10 lakh rupees, for you it is an investment. Now, when you gave me this 10 lakh rupees, are you going to give it with an objective to do charity? Obviously not. You definitely want some returns. You told me that we will give you 10 lakh rupees provided in return, you give us every year 15%. So now what is this 15%? This is the minimum that you expect. This 15% is the minimum that you expect. And what you are expecting on your investment is nothing but cost to me. So this is COC. So now what is the utility of this cost? What is the utility of this rate? I'll explain you. Now suppose I have already decided where I should invest money. बिजनेस तो मुझे पता ही है कौन सा बिजनेस है. तो वो बिजनेस में से मुझे लगता है, मैं फाइनेंस मैनेजर हूँ, I have done the calculation and I think that this business is going to help me to earn 20% rate of return. So you guys tell me honestly, should I start this business now? People would say yes. But on what basis are you saying yes? Obviously you cannot decide. So how should I come to know whether I should start this business or not? Now when you gave me this 10 lakh rupees, you told me that please ensure every year we earn at least 15%. This is the minimum that you guys want on your investment. Now the minimum that you desire is 15%. If I am using your money and if I'm using it in the business, can I say for you guys I'm able to earn 20%? So what should I do? Should I start this business? Now you can say yes sir, because what we expect is only 15%, but what we are getting is 20%. So since we are able to earn more returns, we should go ahead with this business. Achha, if I now hide this rate, now if I tell you, should we start this business? You would say, sir, it depends. Now, yes. Because what you expect is 15%, I'll be able to earn 20% for you guys. Okay, now suppose if I say I can earn 10% return from the business for you guys. Now tell me, should I start the business? You would again say, it depends. Now, no sir, reject. So can I say this, what is minimum returns expected by you, which means which is cost to me, this is acting as a cutoff rate. It is acting as a hurdle rate. It is acting as a cutoff rate in determining whether I should use your money in a new project or not. Should I use that money in the business or not? Are you getting it? That's the relevance of this cost. So this rate acts as a cutoff rate in determining whether we should invest in long-term proposals or not. Did you get this? I hope everyone is following what is happening. So we have discussed meaning of the term capital, money needed to run or start the business. Cost is whatever you guys expect on your investments is profits to you, but it is cost to me. The relevance of this rate is this rate helps me to decide whether to invest in long-term proposals or not, as this is going to act as a hurdle rate, a cutoff rate. Okay. Now, what are we supposed to do now in this entire chapter? Just find this rate. So the whole chapter, friends, can you imagine, is just dedicated to get this rate. That's it. Whole chapter is on getting these rates. So let's understand how do we calculate these rates. Now, before we do that, let me take an example here now, continuing with the same thing. For the time being, let's presume everyone in this classroom is a debenture holder. Let's presume everyone is a debenture holder here. I am again the finance manager. I come across to you and I tell you, "Arey, awesome business here. Debenture holders, mast business hai. वो business के लिए ना पैसा चाहिए. Are you guys willing to invest?" You said yes. Why not? We should and we would be. How much money do you want? I said 10 lakh rupees. So what will I do, a finance manager? I will issue debentures of rupees 10 lakh. So I'll give you 10 lakh rupees worth debentures. Against that, I'll collect 10 lakh. अब आपके पर्सपेक्टिव से सोचूं तो कहने से आपने मुझे 10 लाख रुपया दिया है. That is your investment. And that debentures will be a liability for me of rupees 10 lakhs. Now, when you are giving me this 10 lakh rupees, it's obvious every rational human being will expect something in return. Now, if you are a debenture holder, you will expect returns in the form of interest. Now, when you gave me, or when you were planning to give me the 10 lakh rupees, you asked me a question. Acha, if we give you 10 lakh rupees, how much in return we will earn? I say 5%. You will say, "Ghar pe jao." I said, why? Because you will say that if the 10 lakh rupees, if we invest in bank FD can also give us interest at the rate 8%. So why should we invest? So we will not subscribe to your debentures. So then I say, okay, even I will give you 8%. You will still tell me, "Ghar pe jao." I said, "Kyun?" Because investing the 10 lakh in bank FD is virtually risk-free. But investing your money in this company's debenture is risky. So you would not subscribe. So then I only asked you, how much do you want? You said, for the company like you, we would be happy to earn 10%. So can I say, minimum that you guys are desiring is 10%. And whatever you desire becomes cost to me. So here, this is 10% what you desire in the form of interest. And whatever you desire, as I told you, becomes cut off for me. Means now this 10 lakh rupees, wherever I invest, friends, now this 10 lakh rupees, wherever I invest, मेरे लिए cut off कितना? At least 10% every year. So I have to earn every year in percentage 10 in rupees 1 lakh. Then only I'll be able to give you what you guys want. Did you get this? So this was a cutoff for debenture holders. Now, let me continue the same example, and if I now say, let's presume that everyone here is not a debenture holder, but is a preference shareholder. So I'll do the same thing, must business hai, and I'll issue preference shares and I'll collect 10 lakh rupees from you guys. Now this time you are a preference shareholder. So again you will expect some returns. The returns which you will expect this time on your investment will be in the form of preference dividend. So the returns which you expect on your investment again becomes cost to me. You said that we will give you 10 lakh rupees provided in return you give us every year preference dividend to the tune of 12%. Now what is this 12%? This is what you are expecting. What you expect is profits to you becomes cost to me, cut off to me. मतलब क्या friends? इस बार अगर मैं ये पैसे प्रेफरेंस शेयर होल्डर से रेस करता हूं तो बाय हुक और बाय क्रुक कहने से मुझे एटलीस्ट एवरी ईयर 12% कमाना ही पड़ेगा. Anything less than that, preference shareholders, I'll not be able to meet their claims. So this was all preference. In the first case, all debentures. Now, tell me honestly, of all the class of investors that you have, who takes maximum risk? Obviously, equity shareholders. So let me take it this time. I decided that entire money of rupees 10 lakh, I will be raising it from equity shareholders. So if I raise this entire money from equity shareholders, what will happen? They will also expect something. They told me that we will give you 10 lakh rupees provided in return every year you earn for us 20%. That is in rupees 2 lakh, in percentage 20%. It means what you guys are now expecting, can I say, is cost to me. Here, this time the cutoff for this becomes 20%. यानी कि अब अगर मैं यही 10 लाख रुपीस पूरा इक्विटी शेयर होल्डर से रेस कर लूं तो मेरे लिए कट ऑफ कितना हो जाएगा? 20%. But tell me honestly, is it that we will raise all funds entirely from one source only? Is it that? No. You know, this is what we have learned in capital structure. Not necessary that you will raise entire funds from one source. Let me presume I plan to raise this way 2 lakh rupees by way of debt, on which you guys expect 10%. 12% I will raise by way of preference share capital worth rupees 3 lakh, and the equity shareholders balance amount I will raise by way of 5 lakh. So my dear friends, first of all tell me, is this pattern of arranging money possible? Of course yes, it is possible. So tell me, if this is the pattern in which I arrange money of rupees 10 lakh, this time what becomes my cutoff? Itna to minimum kamana hi padega. Think on your own and tell me, how much do you think should we earn minimum? You know, when I discuss this thing in the classroom, people will say, sir, 42%. Sir, 14%. Now 42%, how did they get it? 10 plus 12 plus 20, that's going to be 42%. Then somebody said, no sir, 14% average. Then somebody said 20%, but that will be the wrong values. You think and tell me, how much minimum should we earn now? How much minimum? If I am the company, how much minimum? What becomes my cutoff? And if you notice, that cutoff is going to be 15.6%. Sir, 15.6%, how did you get that, sir? I will explain you by way of a working. So let us understand this by way of a working. Okay. First of all, so this is my example. With the help of that example, now we can actually do the calculation. Tell me, what are the sources that I have? And the sources that we have is debt, we have the preference share capital, and we have the equity share capital. अच्छा, मैंने डिबेंचर होल्डर्स से कितना अमाउंट रेस किया है? तो I would say we have 2 lakh rupees, we have 3 lakh rupees, and we have 5 lakh rupees. This is making a total of rupees 10 lakh. Up, if I use this amounts, now tell me, as a debenture holder, how much are you expecting in rupees on this? 2 lakh pay, you are giving me 2 lakh because you want at least 10% return. In rupees you want, in percentage you want 10, but in rupees can I say 20,000? This is 20,000 what? It is the return which you are expecting in rupees, and whatever you expect is cost to me. तो कहना से ये 2 लाख पे मेरा जो कट ऑफ इन रुपीस बनेगा, कॉस्ट इन रुपीस, कहना से वो 20,000 रुपीस हो जाएगा. Preference shareholders ने 3 lakh rupees हमको दिए हैं, but they are expecting how much on that? 12%. So in rupees, how much they are expecting? Can I say, friends, 36,000? Yani if I raise 3 lakh, then on this 3 lakh, my cutoff is 36,000. Itna kamana padega so that I can give to the preference shareholders. And here, can I say it's going to be 1 lakh rupees? This is making a total of 1,56,000. मतलब अब ये 10 lakh को मैं जहां भी invest करूं, I have to ensure that I earn at least 1,56,000 rupees, because if I earn 156, I'll be able to meet the needs of all the investors. So in rupees, 1,56,000. In percentage, 15.6%. How did you get that? Can I say it's 1,56,000 by 10 lakh into 100? That's going to give me 15.6%. So my dear friends, what's the formula now for cost of capital? ये 15.6% जो मेरा कट ऑफ है, इसके लिए फॉर्मूला क्या हो गया? This is COC. Formula, can I say I took the total cost in rupees by total capital into 100. That's going to be the formula for your cost of capital. Did you get this? Now, there is one more way, friends, to get the same answer. I can calculate the same in one more way. What I can calculate one more way? I can calculate the answer of 15.6% in one more manner. Let's understand that alternate way, which I would prefer to calculate. Acha, tell me, if I now use these amounts as my base to compute weights, see how it will be shown like. If I'm investing 1 rupee in the business, then what is the proportion of debt in it? The proportion of debt here is 0.2. The proportion of debt is 0.2. Preference becomes 0.3. Equity is 0.5. On this 2 lakh, in rupees, this is what you're expecting. But on this 2 lakh, in percentage, how much you are expecting? In percentage, 10%. So what you expect, can I say, is cost to me? So that is cost in percent. So you guys are expecting 10%. In percent, preference shareholders are expecting 12% and equity shareholders are expecting 20%. Now, if I take sum of the products of weights times cost, sum of the products of weights times cost, I'll still be able to get the same answer, 15.6%. See now, this is going to be 2, this is going to be 3.6, this is going to be 10. So when I sum it up, this is going to be 15.6%. And what is this 15.6%? This is cost of capital. So now that means wherever I am going to put to use your money, I have to ensure that I earn 15.6% every year. Did you get this? And as I told you, the whole chapter rotates and revolves just in calculating this 15.6%. Now, tell me honestly, this cost of capital which I have calculated here, is it simple average or weighted average? Obviously, I'm using weights, so this is which? It's weighted average. So actually speaking, friends, the name of the chapter also should have been not just cost of capital, it is, to be precise, weighted average cost of capital, but that word weighted average is silent. So we have weighted average cost of capital. Okay. And as I told you, the whole chapter rotates, revolves just in calculating this cutoff, 15.6%. But friends, what is required for calculating this 15.6%? What is the basic necessity? Tell me. Can I say, to get this 15.6%, we need cost in percent and we need these weights. To compute this cost of capital, which I have just told you, it is weighted average cost of capital. Hence, I can even call this as weighted average cost of capital or WACC. To get to this is also called as overall cost of capital. Sab itna kamana padega so that you can meet the need of all the people. Overall cost of capital. To get to this 15.6%, can I say I have to first learn to calculate how much debenture holders are expecting on their investment in percent? And what you expect becomes cost to me. So I have to find out how to compute this cost of debt, how to compute this cost of preference shares, how to compute this cost of equity. If I get to know all these things, then and only then I can calculate the overall cost of capital. So to calculate this overall cost of capital, we need to learn first to calculate respective cost of capital. That is the specific cost of capital. But that will not be sufficient. If you learn to get all these things, still you require weights. Now from where do we get these weights? We'll get the weights from these amounts. And from where we will get these amounts? These amounts will be available in the question. So weights usually will not create any kind of problem for us. We will have these values will not be given directly in the question. In my example, I gave it to you to simplify it, but this will not be given. So first we'll have to calculate cost of debt, cost of preference shares, cost of equity shares. Then only we can calculate the overall cost of capital. Did you get this? So the whole chapter rotates, revolves to get this. To get this, we need all these things. So now, how would we progress the lecture? First, we will discuss how do we calculate these respective cost of capital so that we can calculate the overall cost of capital. Thereafter, we'll even do some discussion about how do we get these weights as well. So this is the entire, I can say, a bird eye view of the chapter. Now, one thing is for sure that once I get this 15.6%, what does it mean? अब ये 10 लाख रुपीस मैं जहां भी इन्वेस्ट करूं वहां से मुझे एटलीस्ट 15.6% कमाना पड़ेगा. This chapter of cost of capital, from that we will get that rate. That rate can also help us to do one more thing. This rate is also useful in determining the best capital structure, the optimum capital structure. But sir, यही आंसर तो कैपिटल स्ट्रक्चर ने भी दिया था, which is the best capital structure. हाँ, as per that chapter, the best capital structure is that which maximizes your EPS. Now this is cost. So as per this chapter, which capital structure would be the best? The capital structure where your overall cost of capital will be the least, that capital structure would be the best. Sir, we are not understanding. Okay, let's take and continue with the example. Suppose, is this the only pattern available with me for raising money? No. Can I raise the money like this? 6 lakh debt and 2 lakh preference and 2 lakh equity. Is it possible? Yes. This is the pattern of arranging this money. Now, when I did this calculation, same way, let's presume, I'm not doing the exact calculation, let's presume I'm getting the answer, say 12%. So यहाँ पर भी 10 लाख तो मिल ही रहा है, यहाँ पर भी 10 लाख मिल रहा है, लेकिन इस 10 लाख का मेरा कट ऑफ कितना हो गया? 12%. So between the two, whereas इस 10 lakh का कट ऑफ कितना है? 15.6%. Between the two, tell me which option is preferable. Obviously this, because my cutoff is less. So cost of capital also helps us in deciding the best capital structure. And the best capital structure is that where overall cost of capital is minimum. So there are two purposes. One, it will help me to determine how much I should earn. And second, whether this capital structure is best or not. So sir, in practical life, what is your opinion? What are we supposed to do? In practical life, whether we should go for EPS or whether we should go for cost. Now, in practical life, you will have to put in efforts. You will have to put in judicious efforts to find out such a capital structure where your EPS is maximum, at the same time cost of capital also should be minimum. So that efforts you need to put in. Is it okay? Fine. So this was overall meaning and objective. Now I'll be taking up the computation of those respective costs of capital so as to calculate the overall cost of capital. Is it okay? Fine. So that I'll explain. Before that, I would suggest you can take a screenshot of this thing so that when you have to revise, you can actually, go through this. So take the screenshot of this. Okay, so now let us calculate the first specific cost of capital, that is going to be the cost of debt. So let me take up the first one, that is debt, and we learn how to calculate this cost of debt. This cost of debt, friends, is denoted by letter KD. In FM, the word cost is to be denoted by letter K, and if I'm adding D to it, then it becomes cost of debt. I will take one example. The same example would then follow for the other sources of finance, only the values will change, that's it. So we'll discuss one case exhaustively for debentures. That is the same logic that will be applied for equity as well as the preference and all. So let's understand this. For calculating this cost of debt, what I would like to do is, I'll first begin with the investor's point of view, and whatever the investors are expecting, as I told you, that itself is going to be what? Cost to me. So first I'll begin with investor, and then the same we'll discuss from company's point of view. Now let's understand it this way. I am the finance manager of your company. Awesome business I have come across. I decide that I want to start this business, but me being finance manager, as I told you, I'll not invest money. So I approached you guys and I told you, "Arey, mast business hai yaar, let's capitalize that business." You said, "Fine, we will start the business. Why not? We should go ahead." But then I said that business requires money, and you asked me, "How much money do you want?" I said 100 rupees. So purposely I'm keeping a small figure so that objective is to understand computing the cost. So you said, "Okay, fine, we will give you 100 rupees. Now, if you are an investor, from your point of view, can I say that 100 rupees becomes an investment? You are giving me that 100 rupees. So that is going to be your investment. And your investment here was rupees 100. Now, when you gave me this 100 rupees, you gave it with the condition saying that we want something in return, in turn. So I asked you, how much do you want? You said, ensure that we want returns every year to the tune of rupees 10. Now, if you are a debenture holder, you will expect returns, can I say, in the form of interest. So you gave me this 100 rupees and you told me we want interest of rupees 10 every year. Now, so if I ask you, how much profits do you want to earn every year in rupees, you would say, "Sir, 10 rupees. Then I ask you, how much in percent? So you will say, "Sir, 10%. Acha, how did you get this 10%? What you actually did is, you took this 10, you divided it with the investment that you made, and into 100 is going to be your rate of return of 10%, which is 10% per annum. So my dear friends, how much returns are you expecting every year? 10%. Whatever you expect, can I say, becomes cost to me. That is what is the whole basics. So the minimum return that you expect is 10%. What you're expecting is cost to me. So if I now do the calculation here of rate of return, can I say the formula becomes interest per annum, that is the profits for you per annum upon the investment made to earn that returns, into 100 is the formula for rate of return. And what you expect, as I told you, is going to be cost to me. So now think the same thing. Now just twist the table. Think the same from company's point of view. आपने मुझे 100 दिया, वो आपके लिए इन्वेस्टमेंट हुआ, बट मेरे लिए इन्वेस्टमेंट नहीं हुआ, मेरे लिए रोकड़ा मैंने रिसीव किया है. So this 100 rupees that I have received can be termed as my proceeds from the issue, that is net proceeds of, say, rupees 100. Now my dear friends, you think and tell me, once I get this 100 rupees, wherever now I put to use this 100 rupees, wherever, can I say I have to ensure that I earn every year in rupees to the extent of interest? Understand, again I'll tell you. आपने मुझे 100 रुपीज दिया on which you are expecting 10 rupees every year. आपसे जो 100 rupees मुझे मिला, if I invest the same, can I say I have to ensure that I earn every year in rupees 10 every year to the extent of interest that is equivalent to 10 rupees. So I have to ensure that every year I earn 10 rupees. That is to the extent of interest. So how much I should earn in rupees 10, in percentage 10%. अच्छा अभी कंपनी के पॉइंट ऑफ व्यू से वो 10% ढूंढ के बताइए, तो आप फिर से बोलोगे सर सिंपल है 10 by 100 into 100, so that is giving me 10%. अच्छा, how did you get this 10%? By the way, can I say it's going to be interest per annum by net proceeds into 100. So this is the formula for calculating cost of debt, that is going to be KD. Now, so we realize that whatever returns the investors are expecting is gains to them, but it is cost to the company with some variations here and there. Now let's understand it this way. See friends, whenever a company floats securities in the market to raise money, I have to issue securities, float securities. The company has to incur a cost which is called as flotation cost. Now this flotation cost is not liability of the investors. You don't have to pay those flotation costs. The cost of flotation is to be borne by the company. Examples being advertisement, printing and stationery, hiring professionals. So yeah, issuing security is not an easy task. So it requires a lot of cost. ये cost मेरे लिए है, and I have to pay this cost, not the investor. So let us presume that the cutoff, or rather I would say let us presume the flotation cost was rupees 10. अब just visualize this scenario. मैंने आपको एक डिबेंचर दिया of rupees 100 at 100 and आपसे मैंने 100 rupees collect किया. On this 100 you guys expect in rupees 10 in percentage 10. But let's presume this way, there was a flotation cost of 10 rupees. So by that time that 100 will reach me, can I say I'll be left only with 90 rupees, क्योंकि उसी में से मैं 10 rupees पे करूंगा. तो अब मेरे पास अवेलेबल अमाउंट फॉर इन्वेस्टमेंट कितना? 90. अच्छा, इस 90 पे भी क्या मेरा कट ऑफ 10% होना चाहिए? If on 90 I keep a cutoff of 10%, can I say then I'll earn 9 rupees every year? In rupees I'll earn 9. But will I be able to give you 10 rupees? No. Then can I say on this new funds I'll have to earn in rupees 10, but in percentage more than that. So if I assume flotation cost of rupees 100, so what will happen? 90 rupees is the 100 rupees is the issue price. 90 rupees would be the net proceeds. तो अब मेरे पास रोकड़ा available for investment कितना है? 90. But this time when I invest this 90 rupees, I have to ensure that I earn every year in rupees still 10, but in percentage a bit more. So here if you notice, I'll keep 90 rupees. So 10 by 90, that is going to give you something, I guess 11.11%. So what is happening now? So cutoff for me is 11.11%. But sir, since long you are saying whatever you expect is cost to the company, whatever you expect is cost to the company. Why the cost here is more? Simple reason, because of flotation cost. Means what is happening now? I will have 90 rupees with myself for investment. Wherever I invest this 90, I have to ensure that I earn 11.11%. Because if I earn 11.11%, then I'll be able to give you 10%. On 90, 11.11% is 10 rupees, then I'll be able to give you 10 rupees. So for me, the cutoff is not 10%, it's going to be 11.11%. Why cutoff to the organization is more? Only because of one reason, that's due to the flotation cost. Did you get this? So this is the formula for calculating KD. So if I summarize my discussion here, if I summarize the discussion here, and if I tell you, develop the formula for KD, cost of debt, the formula becomes interest into 1 minus tax, or rather I would say interest by net proceeds. And if you want the rate always to be in percentage, at the end you can multiply it with 100. Now this KD which we have calculated here, friends, is it KD before tax or after tax? You just have to think this way. This interest figure which I have considered here, is it coming before tax or after tax? Chapter of leverages, capital structure, EBIT minus interest, EBT less tax. So can I say interest comes before tax? यानी कि ये जो KD हमने compute किया है ना friends, that is definitely KD before tax. So if I tell you calculate KD not as KD before tax, but calculate KD as KD to be after tax. Tell me chartered, anything which is before tax, how do you convert the same to post tax? What do? You just have to multiply it with 1 minus tax rate. So if I tell you develop the formula for KD as after tax formula, so the formula will be interest into 1 minus tax rate by net proceeds into 100. KD after tax will be, since interest is before tax, you will always convert that interest before tax to after tax. How? By multiplying it with 1 minus tax rate. And if nothing is specified, we'll be using this formula for calculating KD. Why, sir? I will tell you the reason. Because KO, which I want to calculate, that overall cost of capital, that 15.6% which is there in my example, this KO which I want it always to be after tax. That weighted average cost of capital that I need is always after tax. Can I say this KO itself is made up of what? KD, KP, KE, KR. That means all these things make up the KO. Now if you want KO to be after tax, can I say everything here should be after tax? It is the interest which comes before tax, and hence to convert this I always will be taking after tax. It's a KD which is always before tax because interest comes before tax, and hence to get this KO after tax I'll always take KD as after tax. Now sir, why do we need KO after tax? That I'll tell you in the chapter of capital budgeting. This is not the right time to tell, but definitely the KO that we need is after tax. To get KO after tax, I want KD to be after tax, and hence I'll be using this formula KD after tax. Did you get this? Okay, so now if you have really followed, what conclusion do you draw, friends? You realize that whatever is the returns that you guys expect, is gains to you, but that is cost to me. Only due to flotation cost, the cost to the organization will be high. Else whatever you desire is always cut off for me. Now, if you have followed my example, then you would be precisely telling me the conclusion. ये जो KD हमने यहाँ पर अभी compute किया है, is it for fresh issue of debentures or is it for the existing debentures? You think about my example that I've spoken. I am going to issue one debenture and I will collect 100 rupees from you. So this is for fresh issue or is it for existing? Obviously for fresh issue. So this KD ka formula which we have learned, it is for fresh issue. Now, what if your debentures are already issued in the past? They are existing debentures. Then what will be the change in the formula? Then the formula for KD will be KD after tax will be just equal to, think. Now, if you are an investor who wants, I'm again telling you, whatever you guys want on your investment is profits to you, it is cost to me. So now you tell me, if you want to buy an existing debenture, and if you want to invest your money in an existing debenture, you will buy at what price? Can I say prevailing market price? And your prevailing market price becomes the investment, and that is, on that you will expect some return, and what you expect becomes cost to me. So the formula for KD for existing debentures will be what? Interest into 1 minus the tax rate divided by the market value of debentures into 100. In short, just make it as a thumb rule that if it is a fresh issue, in case of fresh issue, you will always write net proceeds. How do you get the net proceeds? Net proceeds of 90, how did I get it? This was issue price. I was assuming one debenture was being issued at 100, that is at par. So this is issue price minus the flotation cost gives me the net proceeds. Issue could be at par, it could be at premium, it could be at discount. Don't follow company law here. If the question says issue is at discount, follow what the question says. Don't argue with the question. So issue price minus flotation cost gives me the net proceeds. Issue could be at par, it could be at premium, or it could be at discount. This part I have discussed in capital structure as well. If there is an existing company and if it is planning to go for a new issue, then the fresh issue, unless specified by the question, we will always assume the issue is going to be at the prevailing market price. So this is the formula for calculating cost of debt. And if so, what you should do now, friends, first check in the question the debt given is which one? Fresh issue, that is new issue, or existing. If it is fresh, apply this formula. If it is existing, apply this formula. So wherever we have net proceeds, against those net proceeds we will just substitute market values. That's it, nothing else. Is it okay? Fine. So now one point that I would like to discuss, because that will be giving me the start to the next point, और वो पूरा discussion हो जाएगा. My KD part is done. एक बार cost of debt हो गया, same lines we will go for preference shares and then the equity. Then it is just discussing the formula. Tell me, chartards, what assumption have I taken here? In my entire part of the discussion, what assumption do you think have we taken here? Look at the conclusions and all these things. You know, the assumption that we have taken here is you are expecting 10 rupees every year. But for how many years? That we didn't think only. You expect 10 rupees interest every year for how many years? You are expecting interest of rupees 10 every year for infinite life. Till infinity is what you are expecting. That means that 100 rupees which you are going to give me, on that you want me to pay you interest every year for how many years? For infinite life. If you want 10 rupees every year for infinite life, it means now nowhere you are asking back your principal amount. See, when you're giving me a loan, don't you think on that loan you want interest for sure? But after some point of time you will also want back your principal investment. So that part we have not considered here itself, because when I'm assuming that I want interest every year of 10 rupees for infinity, I'm assuming that the debentures here are not redeemable. They are irredeemable. They are perpetual. So this formula that I have just discussed for you guys is actually for irredeemable debentures or irredeemable debt. This is for irredeemable debt. But friends, can I say debt will be redeemable. After some point of time, you have to give back the principal amount. So if debt is redeemable, then what is the formula? That is what we'll learn. Once that is done, preference shares, equity shares will follow in the same manner. So you don't have to worry about that. Is it okay? This was one basic exhaustive explanation I've done for debentures. Same logic can be applied to preference shares and the equity share as well. So that we'll understand in a while. Meanwhile, I would suggest you can again just take a screenshot of this thing, because it can be of use to us. Okay, so now we just discussed that whatever formula we have used at present, that was calculating the cost of debt which was redeemable. Now what if that was rather irredeemable? Now how do you calculate cost of debt which is going to be redeemable? So the formula for cost of debt which is redeemable, how it is calculated? So the formula I can now say here, cost of debt, that is KD. You need to now check, friends, whether the debt is irredeemable or is it redeemable. Because if it is redeemable, then the formula will change, and if it is irredeemable. So here the formula was what? KD equals interest into 1 minus tax rate by net proceeds. Now, as we all know, this we want always to be after tax, and this is for fresh issue. If it is existing debt, then the word net proceeds will be getting substituted with what? Market value. Now, how do we calculate KD which is redeemable? For that, we can take one example, but before that, if no information is given in the question, we will always be assuming that the debt is irredeemable, and we'll be solving the sums assuming that it is irredeemable. Now, how is debt redeemable calculated? The formula will be what? The formula is interest into 1 minus the tax rate plus the redemption value minus the net proceeds by n. The whole is to be divided by redemption value plus net proceeds by 2. This is the formula. And again, wherever we have net proceeds, that is going to be for fresh issue of debt. If it is existing, then it is going to be market value. That's the only change that will happen. Now, so let me take an example, and I'll actually tell you what does this formula signify. Friends, in my example, I got the answer 11.11% for this debt which was irredeemable. So can I say that 11.11% was actually 11.11% per annum? That implies every year for me the cutoff is 11.11%. Every year 11.11%, can I say, can also be stated as on an average every year I have to earn 11.11%. Understand the wording. I have to earn 11.11% for how many years? For infinite life. So that was 11.11% per annum for infinity. That means average also, can I say, will be the same. So I can call this 11.11% also as to be my average cost of debt. So just keep that stuff at the back of the mind. Now, how do you calculate debt which is redeemable, KD which is redeemable? Let me take an example here, and then we'll apply the formula. Once you get this formula, we'll immediately below this discuss cost of preference share, and then we'll discuss the equity. So let us assume the company is planning to issue 10% debentures of rupees 10 lakh. Company is planning to issue 10% debentures of rupees 10 lakh, and the applicable tax rate to the organization is say 40%. These debentures are having a life of say 5 years, and they are going to be redeemable at premium of say 10%. So we have redemption value, so redeemable value at premium of 10%. Let's assume the flotation cost now here is say rupees 50,000. And now I tell you, calculate the cutoff of this debt, that is KD. So how would you calculate this cost of debt, that is going to be KD? Now this cutoff of KD, first you need to check. In this sum, is the debt redeemable or irredeemable? If you notice, Life of these debentures 5 years, so it is redeemable. Are these debentures fresh issue or they are existing? Flotation cost dekha, definitely it's a fresh issue. It means this is computing KD for new. Now I would like to ask some questions and you will realize that there's no need to mug up this formula. There's some logic behind this formula. Tell me, how much is the cost to the organization in rupees for entire span of 5 years? If I think from company's point of view, मेरे लिए total cost in rupees for 5 years कितना? When I say cost, it means what is your expectation is cost to me. So मेरे लिए minimum cost cut off कितना है? Can I say every year I have to earn in rupees 1 lakh at least, and that's going to be the interest amount. Such interest I have to earn for 5 years time. So can I say one cost to me is going to be rupees 5 lakh. This is the total cost for a period of how many years? 5 years. Now this is the interest cost for 5 years. Can I say this is again before tax? Anything before tax, if you want to convert it into post-tax, what would you do? Multiply it with 1 minus the tax rate. So how much is the tax rate? That's going to be 40%. So I can say 1 minus 0.4. So we converted before tax interest to after tax. But honestly, tell me friends, क्या organization के लिए सिर्फ यही खर्चा है 5 साल का? Do you think this is the only cost to the organization? No. If you notice, these debentures are redeemable and they are redeemable at a premium of 10%. मतलब जब मैं आपसे collect कर रहा हूँ तब मैं 10 लाख collect कर रहा हूँ, but जब मैं आपको देने वाला हूँ return पैसे, तो I'm going to give you 11 lakh rupees. Can I say वो extra 1 lakh मेरे लिए तो cost ही हो गया? So I would say there is one more cost of rupees 1 lakh. Do you think that's the only cost to the organization? Who bears the flotation cost? The investors? No, the company. Can I say that is also a loss to the organization or a cost to the organization? तो मेरे लिए ये भी एक और cost हो गया 50,000 का. So now my total cost for entire span of 5 years is 5 lakh post tax 1 minus tax rate plus 1 lakh the premium at the time of redemption and 50,000 the flotation cost. If I tell you now calculate the average cost in rupees, calculate the average cost in rupees. This is the total cost. I want you guys to calculate average cost in rupees because I have to earn every year some amount. So on an average in rupees, how much I should earn? So can I say I will divide this with 5 and I will divide this with also 5 because I'll be getting the average because the life of the debt is we can say 5 years. अच्छा जब मैं ये solve करता हूँ तो can I say 5 ones are 5 1 lakhs are. So when I write this as 1 lakh, what exactly is this 1 lakh friends? This 1 lakh is nothing but interest of 1 year. That is interest per annum. So don't you think we can slowly and gradually write the values here? So it is interest per annum into 1 minus the tax rate plus what is this 1 lakh? Premium that I'm paying on redemption. The extra amount that is going to go out of my pocket. What is this 50,000? The flotation cost which I'm incurring. तो ये cost मेरा कितना हो गया? 1,50,000. अब ये 1,50,000 मुझे एक alternate तरीके से भी मिल सकता है friends. I can get the same 1,50,000 in an alternative way as well. How? At the time of redemption, how much am I going to pay? I'm paying to you 11 lakh rupees. When I'm getting that amount, how much actually am I getting? 9,50,000. You would say, no sir, we are getting 10 lakh. अरे but ठीक है, but हाथ में can I say effectively 9,50,000 आ रहा है. So जब मुझे मिल रहा है वो 9,50,000 है, जब मैं दे रहा हूँ वो 11 lakh है, तो can I say this difference of 1,50,000 is actually a loss to me. So that I can get it alternate way, 11 lakh, which is the redemption value, minus 9,50,000, the flotation cost. I can say the formula here can also be written like this: redemption value minus the net proceeds by n. Now, when I do this calculation, it's actually 60,000 rupees plus 1,50,000 by 5. That's going to be 30. तो अब ये जो amount आया है 90,000 rupees का, Friends, how would you interpret this 90,000 rupees ka amount? Can I say this is average cost to the organization in rupees? Average cost in rupees per annum. In rupees, I have to ensure that I earn 90,000. We all know that we don't have to calculate the cost in rupees, but the cost in percentage. So first question is, this 90,000 which we are getting, can I say is nothing but this value, which is this figure. Do you agree it's average figure? Yes. अब न्यूमरेटर फिगर जो है ये एवरेज है, बट मुझे जो कॉस्ट कंप्यूट करना होता है वो हमेशा परसेंटेज में कंप्यूट करना होता है. सो वॉट एवर कॉस्ट आई कैलकुलेट, कैन आई से दैट कॉस्ट कैलकुलेशन इज ऑलवेज डन इन परसेंटेज टर्म. तो अब ये 90,000 कमाने के लिए मेरे पास पैसा कितना? This 90,000 rupees which I have to earn this, how much money do I have? Can I say 9,50,000? So what I would have done to calculate the cost in percentage, I would have divided it with net proceeds into 100. So this would be the formula. But then there is some variation that is going to happen again here. What's the variation? Friends, do you agree the numerator figure given is an average figure? Yes. What about the denominator, the proceeds, the net proceeds? Is that also an average? No, it's at the start, it's at the beginning. So numerator figure is an average figure. Denominator, can I say, is at the start. So don't you think there exists a timing difference? Numerator figure is an average figure for 5 years. कि on an average इतना कमाना है. But denominator जो net proceeds है, can I say that is a start. So this is opening, the numerator is average. Don't you think there exists a timing difference between the two values? So how can you eliminate that? How do you think we should eliminate that? Simple, by taking average in the denominator as well. So how do you calculate the average? Can I say average ratios chapter, opening plus closing by 2 is going to give you the average. Opening here is going to be by way of net proceeds. Closing will be by way of redemption value. Opening plus closing by 2, that's going to give you the average figure. Now, whether you write opening plus closing by 2 or closing plus opening by 2, will it give you a different answer? No. So I would prefer to write RV plus NP by 2. Sir, why are we doing this? No, that we did not understand. Redemption value plus net proceeds by 2. The only reason is, since the numerator figure is an average, the denominator has to be an average. To eliminate the timing difference, I'm doing that. So if I now solve it, I can say 1 lakh is the interest per annum into 1 minus 0.4. Redemption value is 11 lakh minus net proceeds of rupees 9.5 lakh. To be spread over 5 years, क्योंकि ये cost मुझे spread करना है, as these are one time cost. Redemption value 11 lakh plus net proceeds 9,50,000 by 2 into 100. So that's going to give me the cutoff. So I think numerator was 90,000 rupees. The denominator 11 lakh plus 9,50,000 by 2 divide equal to into 90,000%. So now that's going to give me 8.78%. So this is going to be the cost, friends, cutoff. I can say every year on an average for 5 years I have to earn 8.78%. So this becomes my yardstick, my cutoff. So if you notice, the formula prevails. See, so there's a logic behind this. So it's actually nothing but calculating the average cutoff for the organization. So this becomes the example for calculating KD redeemable. Now, if it was an existing one, your job would have been just substitute market value in respect of the net proceeds and the task is done. Now this was cost of debt. Chalo, on the same lines, you guys now tell me how would you compute cost of preference shares. Same lines, huh? Cost of preference shares would be KP. Now again you should ask yourself a question. Are preference shares redeemable or irredeemable? If preference shares are irredeemable, then the formula will be what for KP? It's going to be preference dividend including DDT. So whenever you have to calculate dividend, it has to be including DDT. If DDT is not given, so then to any which ways we are going to ignore that. Divide by the net proceeds. So instead of interest, now the variant that I'll write is the net proceeds. Acha friends, you think on your own and tell me, should I multiply this preference dividend including DDT with 1 minus tax rate? जैसे यहाँ पे हमने 1 माइनस टैक्स रेट किया, क्या इसको भी मल्टीप्लाई करना पड़ेगा? नहीं, क्यों? क्योंकि प्रेफरेंस डिविडेंड ऑलरेडी आफ्टर टैक्स ही होता है. So there is no need to multiply it with 1 minus tax rate. How about the redeemable का formula? चलो friends, tell me, what do you think? What will the formula for redeemable? So KP here will be calculated as preference dividend including DDT plus the redemption value minus the net proceeds by N, the whole to be divided by redemption value plus net proceeds by 2 into 100. So this is the formula for KP. So henceforth, when you have to solve sums where we have to compute KD, KP and all that stuff, you first check that redeemable, irredeemable. Redeemable uses formula, redeemable uses formula, irredeemable uses formula. Be careful and check whether debt is existing or new. If it is existing, then wherever you have written net proceeds, you will substitute it with market value. Same for the preference shares. The third source of finance which every company would be having would be equity. Now in cost of equity, when I'll discuss the cost of equity, so cost of equity, do you think there will be irredeemable, redeemable? That concept will prevail? No. Redeemable concept is only in case of debt, because debt is repaid. Preference shareholders also, we have to pay them back their preference capital, but that obligation is not there onto the company in respect of equity. So in equity, this concept of irredeemable, redeemable won't prevail. There will be only one case that the equity is always irredeemable, so you don't have to pay back the equity shareholders their principal amount invested. Is it okay? So this is what is the respective cost of debt and preference share, and that example that I have made. So I would suggest you can take a screenshot of this. Okay. The next and the most important source of finance which every organization is going to have is the equity. So how do you calculate this cost of equity? Friends, in computing the cost of equity, there are different formulas possible. In totality, I would say there are 6 approaches to calculate KE, and since every approach works under different set of assumptions, your assumptions would change, so will the answer change. Let me take up the first approach for computing KE, then at appropriate stage I'll tell you which one should go ahead. But whenever you have to calculate cost of any source of finance, at the back of the mind you should remember that cost is what? It is the minimum returns which the investors expect. So whatever returns the equity shareholders will expect on their investment is returns to them, but it is cost to the company. So now let's understand here the cost of equity by using the first approach, which is the dividend yield approach. This dividend yield approach is also called as dividend price approach. Now I'm again telling you friends, whatever is return that is expected by you guys is itself cost to the company. So I'll just explain you with the help of a small example. So if you're an investor, then whatever you expect becomes the cost to the company. Now for better understanding, let me take up an example. Suppose we are planning to purchase share of this company, say TCS. Now hypothetically, though its market price is somewhere near 2000 rupees, but let's assume for our calculation purpose the market price of the share of TCS is rupees 100. Now you are planning to buy, you are an investor, you are planning to buy a share of this company TCS which is available at say rupees 100. Now will you simply go and buy it? No, you will do some research. Your research indicated that last dividend paid by TCS, last dividend paid, that will be denoted by letter D0. Last dividend paid by the company was, say, rupees 10. And you now are planning to buy this share of TCS. Honestly, tell me, if you plan to buy the share, can you get the share at its face value? No, you will have to buy the share of this company, can I say, at its prevailing market price. So you will have to buy at the prevailing market price. So can I say this market price of the share will be investment for you. Now, if you are investing money by purchasing share of TCS, and if you are following this approach, which approach? Dividend yield approach, then you are going to invest money with an objective to get dividend. So here your objective is to get dividend. So you expect that TCS, since in the past year, has given me dividend of rupees 10 every year. If I plan to buy the share, I would expect the history to repeat. What will you say? अरे यार last year में तो 10 rupees दिया, तो कहने से अभी भी future में भी उसको at least 10 rupees तो देना ही चाहिए. So this is what you guys are expecting on your investment of rupees 100, and what you expect, as I told you, becomes cost to me. So what is the rate of return that you are expecting? The rate of return that you are expecting in percentage is 10. So it is 10 by 100 into 100. That's going to be 10%. And the formula will be what? So rate of return. Now if you are going to buy one share, you will be entitled to get dividend per share. So the formula becomes DPS by MPS into 100. So this is the rate of return which you are expecting, and as I told you, what you expect becomes cost to the company. तो अब आप मुझे बताइए, as per this approach, KE का formula क्या होगा? KE is going to be nothing but DPS by MPS into 100. If you want, you can ignore 100, then at the end, whatever answer you get, you just at the end multiply it with 100. That also is possible. Now, is it okay if instead of using the letter DPS, instead of using the word DPS, I use the letter D? Of course, what's wrong in it? What is this D now? This D is actually nothing but expected dividend per share. Expected dividend per share. In FM, the way cost is denoted by letter K, price of the share is denoted by letter P. So I'll take P, D by P. Now, by the way, which P? This is which price? The market price. Is it expected market price, or is it current market price, or today's market price? So when are you going to invest? Today or in future? Today. So this is the market price of the share today. Price of the share today. So the price of the share today is denoted by letter P0. So when I use the word P0, it is price today. If I use P1, it is price at the end of year 1. If it is P2, price at the end of year 2, and so on. So very simple it is. The formula for KE from company's point of view is D by P0. Now, purposely, I have taken an example in a different manner. Honestly, tell me, this cost computation which you have done for KE, is it for your existing equity shares or is it for new equity? You would say, sir, market price of the share है, इसका मतलब तो ये KE existing के लिए हुआ है. तो अगर new equity आएगा friends, तो आप मुझे बताइए KE का formula क्या होगा? जो KD KP में हमने यूज किया है वही लॉजिक लगाइए. तो कैसे इट्स गोइंग टू बी D बाय नेट प्रोसीड्स. ड्यू टू फ्लोटेशन कॉस्ट मेरे लिए खर्चा बढ़ जाएगा एंड कट ऑफ मेरे लिए इंक्रीज हो जाएगा. सो इफ इट इज न्यू इश्यू देन इट्स गोइंग टू बी D बाय नेट प्रोसीड्स. इफ इट्स एक्जिस्टिंग देन इट हैज टू बी द प्राइस ऑफ द शेयर टुडे, द मार्केट प्राइस. इज इट ओके? सो दिस वाज योर डिविडेंड यील्ड अप्रोच. नाउ so remember, dividend yield approach is nothing but D by P0. Job is done. But there is some problem with this approach. Can anyone think about the problems, friends? The problem with this approach is, here you are expecting dividend of rupees 10 every year. Now can I say, if you are an equity shareholder, you would also definitely expect your dividends of the company to grow every year. This is what you are expecting in future. Last dividend paid was 10 rupees. Now you expect that your dividend should grow every year. But here you are assuming that we will want same 10 rupees dividend every year. So you are not expecting any growth in dividend. Sir, why you did not discuss this concept of growth in debentures and preference share? Because that is fixed. They can't expect any growth in interest or growth in preference dividend. But equity shareholders can definitely expect, yaar. So in this model of dividend yield approach, dividend price approach, growth in dividend is being completely ignored. So if I incorporate growth rate, then I reached on to the next model. What is that? Dividend yield approach plus growth model. So that is the second approach which we need to discuss. See how we are processing and progressing. We discuss, अरे भाई ये तो best है. I am investing money with an objective to get dividend. What dividend you expect become cost to me. तो वो formula apply किया. But अभी formula में एक problem आ रहा है कि an equity shareholder here is expecting constant dividends every year. So that's a limitation. It's obviously possible that you being an equity shareholder, you'll expect dividends of your company to grow every year. So we're ignoring growth in dividend. So we'll incorporate the growth as well. So if we incorporate the growth, then it becomes dividend yield approach plus growth model. More popularly, it is going to be termed as Gordon's formula. So that is what we need to take up the next one. Thereafter, we have the two other approaches which are similar to these two approaches. So now you can have a screenshot of this one. Okay, so let's take up the next approach. That's going to be the dividend yield approach plus growth model. Dividend yield approach plus growth model, and this model, friends, is more popularly also called as Gordon's formula. This is also known as Gordon's formula. And until and unless no information will be given by the question, we are always going to assume that we'll be following Gordon's formula to calculate KE. Now let me continue with the same example here, friends. Let me continue the same example. But before I continue with the example, I want you guys to think about this. Cost is what? Returns expected by the investors on their investment is profits to the investors, cost to me. I'm continuing with the same example. Let's presume market price 100. Last dividend paid by TCS was 10 rupees. Honestly tell me, would you expect same dividend of rupees 10 in future as well? No, you will want your dividends of the company to grow. Now let's presume you expect a growth rate of 10%. Later on I'll give you the formula for growth rate as well. But let's presume at present the growth rate is 10%. So if the growth rate is 10%, then how much dividend do you expect in year 1? So you'll expect 11 rupees. Because last paid was 10, you expect now it should get compounded by 10%. So you'll now expect 11 rupees. How much would you expect in year 2? You'll expect 12.1. How did we get that? 11 plus 10%. Then you'll expect 13.31, and this will continue for infinity. So if I now tell you, if this is the pattern in which you expect profits, this is what you're expecting year 1, year 2, year 3. This is what you're expecting in rupees every year. So how much are you expecting in percentage? How do you calculate the rate of return here now? Friends, mathematically it can be proved. We are not supposed to prove it, but mathematically it can be proved that rate of return will be given by the formula as D1. Now when I say D1, D0 was the last dividend paid. D1 becomes the dividend of the first year. So mathematically this equation, this entire series can be actually proved as rate of return is D1 by P0 plus the growth. So if I substitute the values, I would say D1 is actually 11 rupees, price of the share is 100, growth rate given is 10%. This 10% is actually nothing but 0.1. So I can write this 10% as 0.1. So when I solve it, so that's going to be 11.1. So that's going to give me 0.21, which is actually nothing but 21% per annum. So on an average, every year you are expecting 21% per annum. Now what you expect becomes cost to me. So if I tell you use the same approach and get me the formula for KE from company's point of view, so the formula will become what? KE will be just equal to D1 by P0 plus the growth. That is the formula for calculating KE as per Gordon's approach. Because whatever you are expecting, friends, on your investment itself is cut off for me. So this is KE of which shares? Obviously existing, because I'm using market price of the share. If I tell you calculate KE for new or fresh issue, so what will be the formula? It will be D1 by net proceeds plus the growth. Did you get this? So these are the formulas, and unless specified, will always be following Gordon's formula to calculate KE. Did you get this? So this was, here you are expecting a growth in dividend. Tell me, what is this P0? It is the price of the share today. What is the growth? What is that G? G is the growth rate in dividend which we expect every year. We are expecting that the dividends of the company will grow every year. And the assumption is that growth rate is assumed to be constant. That means you expect that your dividends will grow. They will grow every year. But the rate at which it will grow, that rate is constant. So that is going to be constant rate. So it is P0 plus growth rate there here. And what is D1? It's the expected dividend of year 1. Do not get confused. It is not last dividend paid. It is what I expect to get in year 1. So that's going to be D1, expected dividend of year 1. And how did you get that 11 rupees in the example, friends? It was last dividend paid, that is D0 plus the growth rate. So you need to be careful. If the question says last dividend paid, the last dividend was D0. If the question says company expects to pay dividend, so that's already D1. So then don't add growth in it. So it's D1 by P0 plus G, where D1 is D0 plus the growth rate. So this is going to be the Gordon's formula, which is going to be used in solving the sum. So this was my second approach for calculating KE. Now, the third approach is earnings yield approach. The first approach was dividend yield approach. The third approach becomes earnings yield approach. Now, in the first approach, as an investor, I was investing with an objective to earn dividend. But if I say no, now my objective is not to earn dividend, but to earn profits. So wherever we have written D, that is dividend per share, we'll substitute it with E, that is earnings per share. So in the third approach, the formula for calculating KE will be E by P0. And if you add growth in it, so then it becomes earnings yield plus growth model. So that will be E1 by P0 plus G. So what is dividend now? Every place now we'll substitute E1. Did you get that? So these were 4 approaches that I discussed. Dividend yield approach, dividend yield approach plus growth model, earnings yield approach, earnings yield plus growth model. In the first 2 approaches, we invest with an objective to earn dividend. In the next 2 approaches, we invest with an objective to earn returns, profits. If in the first case you expect to get same dividends every year, it's constant dividend. If you expect growth, then it becomes Gordon's formula. Same assumptions prevail here. In short, it's just a matter of perception, how you plan to invest with an objective to receive what. That will be the model that will be put to use. But theoretically in the class, nothing specified. We are going to use dividend yield approach plus growth model, that is the Gordon's formula. At the end, after this discussion, I would summarize all the formulas, so then you can copy down those things. So you can please take a snap of this one. Okay. So I'll just summarize the formula for you guys so that it's there on one side of the page for you. So we here have the approach, then we have the cost of existing equity and cost of new equity. Now if I follow the first approach, that is my dividend yield approach, the formula for KE will be D by P0, whereas here it's going to be D by net proceeds. Since it is calculated in percentage, at the end you can very well multiply it with 100. If you follow dividend yield approach and you add growth in it, then the formula here will be KE equals D1 by P0 plus the growth. If it is new, then that's going to be D1 by net proceeds plus growth. If you go for earnings yield approach, chalo chartered, tell me earnings yield approach. And here KE will be E by P0, whereas KE here will be E by net proceeds. If you follow earnings yield again, but in this earnings yield you also incorporate growth here. So then the formula here is going to be KE equals E1 by P0 plus the growth, and here KE will be E1 by net proceeds plus the growth. So wherever it is D, you substitute it with E. Wherever it is D1, you substitute with E1. Now let me give you the formula for the remaining two approaches as well. One is the capital asset pricing model. Capital asset pricing model. More popularly, it is called as the CAPM approach. Now that concept of existing new won't prevail in case of CAPM approach. Straight away there is going to be one formula that will be applied. That's going to be risk-free return RF plus RM minus the RF into the beta factor. So as per CAPM approach, the formula for calculating the KE is going to be RF plus RM minus RF into the beta. This is nothing but risk-free rate of return. Risk-free rate of return. This is returns from market. That is returns from index. You can call it Sensex or Nifty. So this is market returns. This is risk-free return. This is market returns. This is beta, which is a measure of risk of a security in relation to the market risk. So this is beta of security. This is beta of the security. That is the risk of the security. We'll be doing a lot of discussion about the CAPM model in depth at final CA level. So at present the objective is just to remember this formula. So please do just remember the formula, where RF is returns from risk-free securities, RM is returns from market, not risk from market, it's returns from market, and then the last one is beta of the security. This part, that is RM minus RF, only up to this part, RM minus RF is termed as risk premium. To be precise, I would say market risk premium. See, anything which you expect over risk free, if suppose risk free is 7%, आपको 10% returns चाहिए, तब रिस्क लेने के लिए आप 3% प्रीमियम एक्सपेक्ट कर रहे हो. सो डिफरेंस बिटवीन RM एंड RF इज कॉल्ड मार्केट रिस्क प्रीमियम. only RM is market returns. Only RM is market returns. But when I say RM minus RF, this combined net amount is market risk premium. So this is what? Market returns. A beta of the security is going to be usually given in the question, so you can just apply the formula. That will be one more way to calculate KE. That is to be followed only if you have beta of the security given in the question, else we would be applying Gordon's formula to calculate this KE. Is it okay? That was one. And the last, I would just write it here, the sixth approaches. That's also very simple one. ये तो सबसे best है. That can be termed as our realized yield approach. We can even call it as holding period return if you want. So we have realized yield approach. Now, ये तो सबसे easy है. As per this approach, you would always want history to repeat. Whatever you have realized in the past, that much you will expect in future, and what you expect in future becomes cost to the company. I'm again telling you, realized is actual. So whatever you expect, whatever you have earned actual, that much you will expect in future as well. What you expect becomes cost to me. I can take an example for better understanding. Suppose when you purchase the share of a company, it was traded at say rupees 2000. So this is your investment that you have made, 2000. After 1 year, the price jumped up to 2300. So can I say price after 1 year won't remain same, so it has increased. It has increased to 2300. Then in the span of 1 year, let's presume this company gave a dividend of rupees 100. So if I ask you how much profits we have earned in rupees, so you would say, sir, 100 rupees is what we have earned in the form of dividend. 300 rupees is my capital appreciation. So I have earned in totality 400. How did I get that 400? P1 minus P0, that is capital appreciation. And D1 is what I have received in the form of dividend. If I want to calculate the rate of return in percentage, this is profit by investment made to earn this profit. I made investment of 2000. So this is what I have earned. So if I write it, I say 400 by 2000. That's giving me 0.2, which is 20%. Now this is what I've actually realized. This is what I've actually earned. Now what you have earned, don't you think a rational human being says, past year में 20% मिला ही है ना, तो future में भी at least 20% तो चाहिए. So what you expect automatically becomes cost to me. So that is one more way to calculate KE using the past data. So KE here will be P1 minus P0 plus D1 by P0 into 100. That's going to be your KE. So there are in totality 6 approaches that we have for computing KE. Once you have these approaches, you can very well dump it and you can get the values. I hope you have followed all the discussion. I would say you can keep this also. So if you want, you can keep the example here of as TCS, because TCS is trading at around 2000 rupees. Okay? So these are 6 approaches which we'll be using while solving the sums. You can take a snap of this because this is, I can say, a bird eye view of all KE. Okay. Okay, so now if I make you guys recollect what we have discussed at the start, you would realize that we had sources. Achha, before I discuss this, I would just discuss one more point, that is cost of retained earnings. And once I'm done with this thing, then I can very well conclude that cost part calculation is done. So what is cost of retained earnings? First of all, what is the definition of the term cost? Minimum returns expected by the investors on their investments is profits to the investors and is cost to the company. Returns expected by the investors on their investments. So tell me, chartered, is this retained earnings an investment of any class of investor? Is this retained earnings an investment? If yes, then it is made by whom and it is which class of investor? Here, retained earnings, can I say, is the amount that actually belongs to the existing equity shareholders. So this is profit which I have retained, which belongs to the equity shareholders. So this is the investment indirectly made by the equity shareholders. So what will be the returns that you will expect on this? If I go by the definition of retained earnings, it goes like this. Cost of retained earnings is nothing but the opportunity cost forgone by the existing equity shareholders. So what does it mean? It means that if this profit was not retained by the company would have distributed it to the equity shareholders. And as an equity shareholder, what you would have done? This same amount you would have invested it somewhere else. And if you would have invested it somewhere else, from somewhere, can I say you would have been able to earn some profits? Now, will you be able to earn that? No, because I did not distribute only, no. So whatever you are losing out there, can I say that much you will expect from me? And what you will expect from me will be cost to me. So I'll again repeat. If this profits were not retained, I would have distributed. If distributed, you guys would have invested it. If you would have invested it from somewhere, you would have earned some returns, which now won't be possible for you because I'm not distributing only the profits, I'm retaining it. So whatever you are losing out there, that much you will expect from me, and what you expect from me is cut off for me. But friends, honestly speaking, it's very difficult for me, for company, to find out what is the opportunity cost forgone. Because equity shareholders have so many opportunities with them for investment. So it becomes really difficult for us to calculate the opportunity cost forgone. And since it is difficult for us to calculate the opportunity cost forgone, in absence of information, we will always assume KR to be equal to KE existing. We will always assume KR to be equal to KE existing. Means what? Whatever equity shareholders expect on equity capital, that much minimum they will expect on retained earnings as well, if no information given. So if no information, KR will always be considered to be equal to KE. Is it okay? So what I did now, friends, here is I have explained you how to calculate cost of debt, how to calculate cost of preference shares, cost of equity, and the cost of retained earnings. Now, what is the purpose of all these things? I know that in the explanation you must have even forgotten that why did we do this calculation. So if I may prepare the table that I prepared at the start here, which had sources, we had debt, PSC, we had equity. In the amount column, I distinctly remember I written 2 lakh, 3 lakh and 5 lakh. So 10 lakh was the capital that I've invested. If I use this amount as my base and if I use it to calculate weights, so this will be 0.2, 0.3, 0.5. Then I multiplied it with cost in percentage. In my example, I took 10%, 12% and 15%. I think 20%. 10%, 12% and 20%. Now how did I get that? I calculated that by using this formula of KD. How did I get the 12%? By using the formula for KP. How did I get that KE of 20%? By using Gordon's formula. Then we took sum of the products of weights times cost. That's going to give me the KO, which I got the answer as 15.6%. So that becomes my KO. So the whole purpose is to get this, but to get this we required these things, hence these discussion that we did till now. So what I'll now do is I'll take up some sums which are just dedicated in computing these respective cost of capital, and then thereafter I'll discuss something about these weights as well, because these two things are necessary in computing this KO. To get this KO, there is need of weights and cost. How do we get this, उसका discussion हो गया है, फिर इसका भी discussion करेंगे, but उससे पहले हम लोग इसके related कुछ sums है वो solve कर सकते हैं. So let us take up the solving of the sums. I hope you people have downloaded the sheet of questionnaire that is available at the website of JK Shah classes. So you can download that and we can start solving the sums, which are just just dedicated in computing the specific cost of capital. So let's take up question number 1. Question number 1. A company issues rupees 10 lakh 16% debentures of rupees 100 each. The company is in 35% tax bracket. You are required to calculate cost of debt after tax if debentures are issued at par, 10% discount and 10% premium. If the brokerage paid is 2%, what will be the cost of the debentures if the issue is at premium of 10%? So there are two parts which are to be answered. Let's concentrate on one part at a time. So let's understand. Now, first, how would you tackle this sum, friends? How would you tackle? Your thought process should be this way. We have been asked to calculate cost of debt. अच्छा, तो debt KD ढूंढना है. ओके, तो सर ने क्या बोला, KD चेक करना है पहले, whether it is redeemable or irredeemable. चेक करो, life of the debentures कहीं दिया उन्होंने? Check. Is it given anywhere? No. So if life of the debentures is not given, then we have to conclude that the debt given is which one? Irredeemable. अच्छा, then next question. एक बार पता चल गया ये irredeemable है, तो is it computing KD for a fresh issue or an existing one? So how do we make out? You check, no? It has been mentioned somewhere. If debentures are issued at par, issued at 10% discount, 10% premium. So can I say this is definitely calculating KD of fresh issue. Existing नहीं है. Existing होता तो market value available होता. Okay, the first thing that I'll now realize is I have to compute KD, which is going to be of irredeemable. So the formula will be interest into 1 minus tax rate. Now divide by net proceeds. अगर ये existing होता तो मैं market value ले लेता into 100. So this gives me the formula for computing KD. Now in the first scenario, it says issue is at par. So here I say issue at par. Now check. What is the worth of debentures that we are going to issue? We are going to issue debentures worth rupees 10 lakh. Now they are going to be issued at par. So can I say if I'm issuing 10 lakh worth of debentures, I will be getting 10 lakh only. Sir, but flotation cost is there. That is there, but that is for part B, not for this part. So when I'm issuing 10 lakh of debentures worth rupees 10 lakh at 10 lakh, I'll be getting 10 lakh as the proceeds. Asha. What is the rate of interest? It's 16%. So on 16% on 10 lakh, can I say will be 1,60,000? Check. Is tax rate given? Yes. The tax rate given is 0.35. So now if I do calculate the KD here, the formula for KD becomes 1,60,000. So that's coming to 10.4%. This is my KD if issue is at par. अब फ्रेंड्स यही आंसर एक ऑल्टरनेट तरीके से भी मिल सकता था. डू यू अग्री? ये कॉस्ट कंप्यूट करने के लिए we have taken into consideration all debentures. While calculating the cost here, we have considered all debentures. If you want, you can even do the calculation of cost, not of all debentures, but per debenture also. Eventually it will give you the same answer only. So now if I do this calculation, I can say this way. What is the face value of one debenture? I think 100. Issue is at par. That means, can I say 100 rupees is the face value? If you're issuing one debenture of 100 at 100, proceeds that you're going to get is 100. Interest will be calculated on what? Again, the face value. The face value is 100 rupees. So interest rate being 16 into 1 minus 0.35 into 100, that's going to give you 10.4%. Now, second, so whether you follow per debenture or whether you follow all debentures, your cost stays the same. Choice is yours. What I would do is, wherever per debenture calculation is possible, I would do that. There could be certain debt where you can't calculate it per debenture or something like that. In that case, you will go for totality basis. So this becomes the answer to 1A.1. In the next case, issue is at 10% discount. Now, the formula won't undergo change. That's the reason I've written it only once. Now, I'll be doing here calculation on per share basis. So, issue is at 10% discount. My denominator is net proceeds. Net proceeds कैसे मिलता है? Issue price minus rotation cost. तो एक डिबेंचर में issue कितने पे करूंगा? 90 पे. तो net रोकड़ा भी मिलेगा 90. Interest will still be calculated on its face value. That's going to be 16 into 1 minus 0.35. So we say 16 into 0.65 divided by 90%. That's going to give me 11.56%. So my cutoff here becomes 11.5%. 56. ये सब per annum ही होता है friends. This is always per annum. So that becomes the answer to the second point. The third one, issue is at premium of, I think 10% again, right? Issue at premium of 10%. Yes. So against one debenture now 100 रुपी का डिबेंचर मैं इशू करूंगा 110 पे, तो मुझे जो रोकड़ा मिलेगा पर डिबेंचर वो 110 है. Interest will still be paid on 16 on the face value, which is going to be 16 into 100. So that's going to give you how much? 16 into 0.65 divided by 110, and that's percentage term, 9.45%. So then now here the cutoff becomes 9.45. This was the answers to point A1, 2 and 3. B1 also is asking me to do the calculation, and in doing that calculation they are saying if brokerage paid is 2%, then what is going to be the cost of the debenture if the issue is at a premium. So I would again use the same formula. So but whether you pay brokerage or don't pay brokerage, your interest will be always computed on face value. So that's going to be 16 into 1 minus 0.35. Up here, one debenture in point B is issued at a premium of 10%. मतलब कहने से मुझे जो रोकड़ा मिलेगा वो 110 मिलेगा. The premium that the debenture will be issued at a premium of 10%. So when I will issue, I'll be getting 110. But then I have to pay brokerage also of 2%. अब ये brokerage कहने से मेरे लिए एक flotation cost हो गया. So जो net रोकड़ा मुझे मिलेगा, net proceeds, is not going to be 110. It's going to be 110 minus the brokerage. अच्छा, this brokerage of 2% I should calculate on what? On 100, that's the face value, or on 110. Brokerage is paid on the transaction value, and my one transaction is of 110, so it will be 2% of 110. It's always on the issue price, the transaction value. So we can say 10.4, I guess, is the numerator. So 110 minus 2% divide equal to into 10.4, so into 100. So this time it's giving me 9.65%. So here this becomes my cutoff. So cost of debt, and this is the solution to your question number 1. So you should be clear in your thought process, friends. Clear. Debt redeemable, irredeemable, redeemable तो formula अलग हो जाएगा, irredeemable तो whether it is fresh or existing formulas change हो जाएंगे and so on. So this was your solution to question number 1. You can have a look at the solution. Okay, it was quite a manageable one. Now, on the same lines, we can straight away finish off question number 3 now. Now, question number 3, what it says. 5 years ago, Sona Limited issued 12% irredeemable debentures at 103 at rupees 3 premium to their par value of rupees 100. The current market price of these debentures is rupees 94. If the company pays corporate tax of 35%, what is the current cost of debenture capital? So what is the current cost of debenture capital? That is what they have asked. So first of all, again, cost of debentures बोला है, तो KD आ गया. Redeemable या irredeemable? Clearly बोला है, it is irredeemable. Now if it is irredeemable, this formula will apply. But what will happen into the denominator, whether I should take net proceeds or whether I should go for market price, that is going to be subjective depending upon the information. So here the debt which I am calculating, it is not an new debt, but it is an existing one. So what will happen into my denominator? Into the denominator, then I will not write net proceeds, but I will write market value of the debentures. So this is a market price of my debentures. Okay. Now, one debenture is currently trading at how much? 94. So ये 94 हो जाएगा. Interest, will it be paid on face value or on market value? It has to be on face value. So the face value is rupees 100. The rate of interest, check karo please, 12%. So that's going to be 12 into 1 minus. What's the tax rate? The tax rate is 35%. So if I do calculate now, so that's going to be 12 into 0.65 divided by 94%. So this is going to be 8.3% per annum. This is going to be my cutoff. So this was solution to question number 3. Did you follow this? So this was computing that specific cost of capital, of which I have already done the discussion. Now we can take up question number 2. Once question number 2 is done, then we will discuss what are the different types of weights. You know, we have to understand that concept as well, because to compute KO, only specific cost is not needed, even weights are required. So let me take up now question number 2. Question number 2, what it says. The shares of ABC Limited is presently traded at rupees 50 and the company is expected to pay dividend of rupees 4 per share. Company expects to pay dividend of 4 per share. So this is D0 or is it D1? Tell me, chartered. Company expects to pay dividend of rupees 4 per share. So they want a dividend of 4 per share, and this is D0 or D1, expects to pay. So this is going to be D1. It has a growth rate of 8%. It plans to raise fresh equity capital. The merchant banker has suggested that an underpricing of rupee 1 is necessary in pricing this issue, besides involving a cost of 50 paise per share on miscellaneous expense. Find out the cost of the existing shares as well as the new equity, given that the dividend rate and growth rate are not expected to change. So here question is telling us to calculate KE. Acha, KE for what? Existing shares or new shares? Both. They have asked us to calculate KE not only just of existing but also KE for new. Sir, we have 6 approaches for calculating KE. Which one do we need to follow? If you notice somewhere information about growth rate is also given. So जहाँ growth rate होगा वहाँ Gordon. So we have to use Gordon's formula here. Now, as per Gordon's formula, could you please tell me how do you calculate KE? As per Gordon's formula, how is KE calculated? KE is D1 if it is an existing by P0 plus growth. If it is new, then the formula is D1 by net proceeds plus growth. Now, whenever you have to calculate KE, both existing and new, my personal request and suggestion would be target first KE existing. In this also follow one appropriate target. In this also follow one appropriate target. Your first target has to be P0, price of the share today. Check. Is price of the share given P0? Yes, I think it's given 50 rupees. This is the price of the share. Check. In this sum, do we have any information anywhere about growth rate? Yes, it is expected to be 8%. So this is going to be 0.08 because 8% is as good as 0.08. If I can get D1, then my job is done. Check D1. D1. Is it given? Yes, we expect to pay a dividend of rupees 4. So this is 4. So if I now calculate KE of existing, then what's going to be the value? So it is 4 by 50 plus 0.08. So that's giving me 0.16. This 0.16 that I have is actually 16% per annum KE existing. So we found KE existing. Now in case of new, again the target will be the same. First the denominator, then the growth rate, then D1. Net proceeds. Now this is an existing company. वो कैसे पता चलेगा? अरे उसका share already 50 पे trade हो रहा है. तो अगर कुछ information question नहीं देता, so what I would have assumed? I would have assumed that I will issue the new share at the prevailing market price of rupees 50. But the merchant bankers have suggested that don't do that. In order to attract the equity shareholders, issue the new shares not at 50, but an underpricing of rupee 1 is needed in pricing the issue. Matlab the new share I'm supposed to issue it not 50, but I'm supposed to issue it at 49. On top of it, to get this 49, am I supposed to incur any flotation cost? Yes, ये मेरा issue price हो गया. मुझे चाहिए net proceeds. Issue price minus 50 पैसे का flotation cost है. So we have flotation cost of 50 paise plus the growth rate, and that's going to be the same 0.08, and D1 is 4. So my answer here will be 4 by 48.5 plus 0.08. So please do the calculation. So it's going to be 4 divided by 48.5 plus 0.08. So that's coming to 0.1625. That is 16.25% per annum. So this is my cutoff. So cutoff for the existing funds is 16%. For the new funds becomes 16.25%. The cost is rising because of underpricing and due to the flotation cost. So I hope you guys followed how do we need to tackle sums for specific cost of capital. So here this was solution to question number 2, I guess. Yes, fine. So this was the discussion about computing specific cost of capital and sums on it. We'll understand now the concept of what are the different types of weights. Okay, so now we are going to discuss what are the different types of weights. So we have types of weights. Now, if you notice, I have made an example here. So we have equity capital, reserves, preference capital, and debentures. And if I now tell you calculate the WACC for this 1 lakh. So whenever I have to calculate WACC, I would be preparing a table. This table is going to have these 5 columns. Now in the first column we have the column for sources, then it is amounts, then we have weights, cost in percentage, weights in cost will give me WACC. So now I will write these sources: equity, share capital, then we have reserves and surplus, then we have preference share capital, and then we have the debentures. So friends, if I ask you now a question, to get this KO, we need specific cost of capital that I've already given to you. KE, KP and KD I've already given you. But along with that, I also need the weights. So from where do we get these weights? Can I say to get these weights, we need the amounts. Now the question is, from where do we get these amounts? Now people would simply jump to conclusion. Sir, question will be given. That I know question will give us. In that question, we will get these values. But if I ask you in a practical life, which document will you refer from where you will be getting these amounts? Which document? So what is the source of these amounts? So can I say the source of these amounts would be the balance sheet. So all these values I will be getting it from the balance sheet. So friends, if I write balance sheet values of each source of finance, so let us take it this way. These are what? These are the values that are appearing in the balance sheet. So we have equity capital 45,000, we have reserves 15,000, preference capital of rupees 10,000, and the debentures are rupees 30,000. Now, so if I take the values that appear in the balance sheet and if I compute these weights, then these weights arrived are going to be termed as book value weights. More popularly, if you want, you can even call it balance sheet value weights. Why? Because we are taking the values that are appearing in the balance sheet. So if you write balance sheet values of each source of finance and if you calculate the weights, so that's going to be 0.45, 0.15, 0.1, 0.3. These weights which I now calculate are now termed as book value weights or balance sheet value weights. So now my heading here will be what? Calculation of WACC using book value weights. Using book value weights. Now, so let's calculate that. Now this is going to be 15 KE. I have already given you 15%. Sir, you did not give KR. But when no information is given, KR will always be equal to KE. So that's going to be 15. Preference is 10 and debentures are 5. So this is my cutoff. Now if I calculate my KD, sorry, the KO, where did the KO? If I calculate that, it will be like this. 15 into 0.45, then 0.15 into 15, 0.1 into 10, and then 0.3 into 5. So that's going to give me 11.5%. This 11.5% is going to be what? This is going to be my KO. Did you get this? Okay. So whenever to compute KO, if we use the values that appear in the balance sheet, then these weights arrived are just termed as book value weights or balance sheet value weights. Now you guys think and tell me if these are the values that are appearing in the balance sheet. So these are funds already raised or they are going to be raised? Already raised. That means, can I say these are existing funds? Yes. So in case of existing funds, we have one type of weights that is going to be termed as book value weights. We have one more type of weights that is going to be termed as market value weights. Now what is that market value weights? Now these are the values that appear in the balance sheet. Do you really think the values that appear in the balance sheet and their market values will be the same? No. Suppose if I continue here, I can say this is say 4,500 shares of rupees 10 each. That means in the balance sheet equity shares are appearing at 45,000 rupees. But if I now ask you what is the market value of equity? Will it be 10 rupees? No. Let me assume it is 20 rupees. So what will happen? Though the value appearing in the books is 45,000, its market value is rupees 90,000. Now you guys think and tell me, will retained earnings have any market value? No. You know why? Retained earnings don't have their separate market value. In calculating market value of equity, the value of retained earnings already gets automatically adjusted in it. So retained earnings per se will not have their own separate market value. So you will be just substituting the equity ka market value that incorporates this value automatically. Suppose preference share capital are 15,000 and let's presume debentures ka value aa gaya 25,000, or rather let me make it 35,000. So that's going to be 140. Okay, 45,000. So this is what is the value of market value of debentures. Now, sir, is it necessary that every source of finance will have market value? No, need not necessarily be. If suppose there was one source of finance, say term loan, तो टर्म लोन सपोज इधर 50,000 का था, तो टर्म लोन का कोई मार्केट वैल्यू नहीं होता. तो इन दैट केस मार्केट वैल्यूज एंड बुक वैल्यूज विल बी assumed to be the same. So these are market values of each source of finance. One type of weight that we have just discussed is book value weights. So if I now take market values of each source of finance, so we have equity, share capital. Should I consider retained earnings? No. Why? Because market value of equity, when I'm writing here, the worth of reserves gets adjusted automatically in it. So we have preference share capital and we have the debentures. Now, so we have 90,000 rupees here, 15,000 and 45,000. So when I take the total, I guess the total is coming to 1,50,000. So 45 plus 15 plus 90, that's 150. So if I now calculate the weights, it won't be the same which is appearing in the books. So these are which weights now? These weights which we just calculate will be termed as market value weights. And if I now calculate KO, the weights if I'm using is the market values of each source of finance. The weights arrived are called market value weights, and the heading would be calculation of WACC using market value weights. Using market value weights. So let's do the calculation. So this is going to be 1,50,000. So 90 divided by 150. So that's giving me 0.6 here. And this is coming to 0.1 again. Fortunately the values are coming same, so let's change it because then you'll get confused there. So let's make this as 35,000, else you'll get confused there. So let's make this as 35,000, and now this total becomes 140. Okay, so now 90 divided by 140. So now my weight comes to 0.64. 15 by 140. Now the weight here comes to 0.11. So this becomes 0.75. The balancing figure 0.25 will be the weights for debt. अब ये जो weight है friends, इस weights को क्या बोलेंगे? Market value weights. The weights arrived will be termed as market value weights, and then you can use the same formula: cost 15, 10 and 5. And this time if I calculate the cost, so it will be 0.64 into 15, then 0.11 into 10, and then 0.25 into 5. So that's going to give me the grand total of 11.95%. So this is also KO. This is also KO. But this KO which we have calculated is the KO calculated using book value weights. This KO that I have calculated is the KO using market value weights. Is it clear? So at present we have discussed two types of weights. One, the book value weights, the other market value weights. Whenever to calculate WACC, if we use the values that appearing in the balance sheet, the weights arrived are called as book value weights. If you use market values of each source of finance and if you then compute the weights, then the weights arrived are termed as market value weights. Now friends, tell me, how would you interpret this 11.5? These are funds already raised or they are going to be raised. So you would say, sir, these are already raised. Achha, already raised means, can I say, they must have been already put to use somewhere. So what does it mean? Wherever this 1 lakh rupees has been invested, wherever this 1 lakh rupees has been invested, I have to ensure that I earn every year at least 11.5%. From what? From the existing project. But suppose now we have to now discuss a third type of weight. So that's the reason I'm taking this discussion. So this 1 lakh rupees is already used somewhere, and from somewhere I have to ensure that I earn 11.11%. But suppose, let's presume our company is planning for an expansion program, and for expansion, let's presume it requires extra money. So let's presume that new project in which the company is planning to invest, or let's say a new business itself. So suppose let's presume this is business of manufacturing and selling biscuits. तो वहाँ से मुझे at least every year 11.5%. अब मैं सोचता हूँ कि नहीं, मैं business नहीं, now I'll start manufacturing books. So for that I will need to make investment in that business. I realize that that books business will require investment of say rupees 5 lakh. So that is what is my new investment or additional funds that I want. अच्छा, तो biscuit खरीद के बेच के at least you have to ensure that you earn 11.5%. तो क्या books के business में से भी उतना ही cut off होगा क्या? नहीं. So that will depend on what? It will depend on cost of that new funds, specific funds, and it will also depend on the weights of these new funds. So we come across to the third type of weight, that is what? The marginal value weight. Sir, what does it mean? Whenever I have to calculate KO for a new project, for an additional project, then I would always follow marginal value weights. When we have to follow, see, market values and book values कौन से funds के लिए होगा? Existing funds के लिए. But अगर new funds है, तो जो आप existing funds पे कमा रहे हो, जरूरी थोड़ी उतना ही आपको new funds पे कमाना होगा. तो how much should what should be the cutoff for this 5 lakh? इसके ऊपर मुझे at least कितना कमाना है? तो मुझे ये check करना पड़ेगा कि how am I going to arrange this 5 lakh rupees? That will help me to determine the cutoff here. Then to calculate that cost of that additional funds, I need weights. So the weights that will be arrived will be termed as marginal value weights. What do you understand the word marginal? Addition, additional. So additional value weights. Now how do you calculate that? Let's understand. My first question is, these are existing funds. बिस्किट्स बेचने के लिए 1 लाख रुपीस का चाहिए, बुक्स बनाने के लिए 5 लाख का अमाउंट चाहिए. फर्स्ट प्रायोरिटी यू विल गिव टू विच सोर्स ऑफ फाइनेंस? सबसे पहले ये 5 लाख रुपया अरेंज करने के लिए आप कौन से सोर्स ऑफ फाइनेंस को प्रायोरिटी दोगे? When I ask the same question in the class, people will jump saying, sir, debentures. Somebody will say, no sir, equity share. But you know friends, the first priority should always be given to retained earnings. अब already आपके पिगी बैंक में पैसा पड़ा है, तो बाहर से पैसा रेज करने की क्या जरूरत है? So first priority should always be given to unutilized retained earnings. If you already have something with you, then why borrow and why raise money? So first priority is always going to be to unutilize retained earnings, if any. So sir, how will I come to know how much is unutilized? That question will tell you. If no information is given, then we will assume कि ये 15,000 पूरा existing business में use हो गया है. अब इस 15,000 में से suppose 5,000 अभी भी use नहीं किया है हमने, तो वो तो मैं नए business के लिए use कर सकता हूँ ना. So if no information given, we will assume entire existing retained earnings are utilized, nothing is unutilized. If unutilized retained earnings are given, then I would give preference to that unutilized retained earnings. You know what is the biggest advantage of retained earnings? First, it carries no flotation cost. Do you think कि raising money by way of equity and raising money by way of debenture is just an overnight procedure? आज दिमाग में आया कि कल पैसा रेज करेंगे तो कल पैसे मिल जाएगा? No, it is one, time consuming, and it is also going to carry huge cost. So that's the reason why we retain profit. So we avoid flotation cost. So first priority is to unutilize retained earnings if it is given by the question, else we will simply ignore. तो अब सर ये 5 लाख रुपए क्या करें? तो 5 लाख रुपए के लिए मैंने जो पैटर्न सोचा है वो है कि आई विल रेज 1 लाख रुपीस बाय वे ऑफ इक्विटी, 1 लाख बाय वे ऑफ प्रेफरेंस एंड 3 लाख बाय वे ऑफ डेट. अब इफ दिस इज द पैटर्न इन विच आई एम गोइंग टू अरेंज फंड्स, तो मुझे मिनिमम इस फंड्स पे कितना कमाना पड़ेगा? देन द वेट्स अराइव्ड विल बी टर्म्ड एज मार्जिनल वैल्यू वेट्स. तो इफ आई यूज दैट इंफॉर्मेशन हियर, आई कैन से दिस वे. So let's take it this way. Amount I will write 1 lakh, preference capital 1 lakh, this is going to be 3 lakh, making a total here of 5 lakh. So when I calculate the weights, that's going to be 0.2, 0.2, 0.6. Let's presume hypothetically the costs also are the same. So this is 15, this is going to be 10, and this is going to be 5. So this is going to be 3, 2, and 3, correct? Yes. So this is going to be 6, 8%. So what is this also? This is also going to be my KO. अब ये KO क्या सिग्निफाई कर रहा है? अब आप बिजनेस में, नए बिजनेस में कितना पैसा डालने वाले हो? 5 लाख रुपीस. तो wherever this 5 lakh is going to be put to use, वहां से आपको एटलीस्ट 8% कमाना पड़ेगा. लेकिन जो एग्जिस्टिंग बिजनेस है, एग्जिस्टिंग प्रोजेक्ट है, वहां से 11.5%. Did you get this? So basically there are 3 types of weights. One, the book value weights, the market value weights, and the marginal value weights. Now, when are we supposed to use marginal value? When are we supposed to use book values or market values? That is for existing funds, friends. You just remember it this way. Whenever we have existing funds, I would want this. Okay. So this is additional funds. I'll just write it here so that you can remember this. Whenever we have existing funds, that are funds already raised, then there could be 2 types of weights. Either we will be following book value weights, or you would follow market value weights. But for which funds? The existing ones. But if we have additional funds or if we have new funds, then you will be following marginal value weights. And friends, you need to remember, in market value weights, ignore retained earnings. Only in market value weights. In additional, that is marginal value weights, if there are any unutilized retained earnings, consider it. If it is already utilized, then ignore it. Is it okay? Fine. So this is your different types of weights that I have discussed. Here in my calculation, I will change it and I'll make it marginal value weights. So I'll summarize the data. I can say this way. In case of existing funds, we may either have to follow book value weights or market value weights. Whenever we calculate WACC using book values or balance sheet values of each source of finance, the weights arrived are called as book value weights. If we use market value weights of each source of finance, then the weights arrived are termed as market value weights. When no information is given by the question, you are free to assume any weights and then do the calculation. Nothing specified preference can be given to market value weights. If you are going to calculate KO for additional funds for a new project, then you can very well make use of the marginal value weights. And in marginal value weights, what happens? What are the weights that we are taking? The pattern of arranging the additional money, the way in which you are going to arrange the additional money, that itself is going to be used as the base for calculating the weights. Did you get that? So that are different types of weights, and this I would suggest you can just take a snap of it. You will remember the entire discussion. Okay, fine. So till now what we have discussed, friends, meaning and objective. Objective is to get that cutoff, that is KO. Then second thing that we discussed was how to get that respective cost of capital, that is a specific cost of capital, KD, KP, KE, KR. Then we discussed what are the different types of weights. Now we'll consolidate all the information that we have discussed till now, and we can make use of the knowledge that we have gathered, and we can solve the sums. So let's understand, we take up the sums that are related to overall cost of capital calculation. Fine. So let's take up question number 4. Okay, so let's take up question number 4 now. Let's read and finish it off. Question number 4. Now this question number 4, my dear friends, it's an examination sum. So I would request that please do refer it during your exam time. Often sums like this have been asked in the exam. So let's read it. Masco Limited wishes to raise additional finance of rupees 10 lakhs. तो सीधा दिमाग का बत्ती जलना चाहिए कि अगर ये sum KO calculation के लिए होगा, and if the question is telling us to calculate the KO for additional funds, we are going to use which weights? Obviously the marginal value weights. It's planning to raise additional finance of rupees 10 lakh for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings, which is available for investment purpose. Further details are as follows. Debt equity mix is given 30%, 70%. Cost of debt up to rupees 1,80,000. Beyond rupees 1,80,000, it is 16% before tax, and up to 1,80,000 it is 10% before tax. Earnings per share is given. The dividend payout is given to be 50% of the earnings. Expected growth in dividend is given to be 10%. The current market price of the share is rupees 44. Applicable tax rate is 50%. You are required to determine pattern for raising the additional finance. Determine the post-tax average cost of additional debt. Determine the cost of retained earnings and the cost of equity, and compute the overall weighted average after tax cost of additional finance. So there are four things that we have to answer. So let's concentrate on one thing at a time. Determine the pattern of raising the additional finance. So let's understand the pattern, the manner in which we are going to raise the additional finance. First of all, tell me how much is the additional finance that is needed. So let's answer this. Additional finance that I need is rupees 10 lakh. Now, while arranging this 10 lakh rupees, you have to take into consideration, while arranging this 10 lakh rupees, you have to ensure some conditions given by the questions are satisfied. Now, what are that? First condition I would say would be that we would be interested in maintaining that debt equity ratio. The debt to equity ratio should be in 30:70 proportion, if I'm not wrong. Check. In a debt to equity 30:70 chahiye. That means of this 10 lakh, the proportion of debt here would be 3 lakh and equity would be rupees 7 lakh. Now when I'm using the word equity, it is actually speaking shareholders fund. So you need to remember that. Debt. Acha, can we arrange debt at a flat rate of interest? Is the debt available to us at flat rate of interest? No. There are slab rates available, if you notice. Now, it has been specified that debt up to rupees 1,80,000, the rate of interest is 10%. Am I correct? Up to rupees 1,80,000. So here, if you raise up to 1,80,000, then you will be charged interest at 1 lakh at 10%. If you cross 180, then it is going to be 16%. So that's going to be, we will require additional 1,20,000. Did you get this? Okay. Now, in case of equity, which is actually shareholders funds, how much and how would be the pattern? 7 lakh should be equity, because if I have 7 lakh of equity, then my ratio is maintained. अब उसमें से मेरे पास 2,10,000 already available है friends. 2,10,000 is unutilized. That's already available. So we can say we have retained earnings of rupees 2,10,000. So that means I will have to go for fresh issue of equity to the tune of rupees 4,90,000. Yes, 4,90,000. So this is the pattern of arranging this additional funds. The way in which I would arrange the additional finance. 1,80,000 by 10% debt, 1,20,000 by 16% debt, 2,10,000 by retained earnings, equity 4,90,000. Is that clear? Okay. Now let's read B point, what it says. Calculate, determine the post-tax average cost of additional debt. So I can give the heading calculation of post-tax बोला तो friends क्या होगा? Post-tax is after-tax cost of additional debt. After-tax KD पूछा है उन्होंने. So whenever we have to calculate KD, KB, KO and all that, we have to simply prepare a table. So here we have table which has sources, it will have amounts, weights, cost in percent, weights times cost gives me the WACC. Sources में हम लोग चेक करेंगे, मुझे सिर्फ डेट के बारे में फोकस करना है. तो डेट we have of 10% rate of interest, that is one. The other we have 16% debt. The amount of debt here is 1,80,000 and this is 1,20,000. So when I take up the total, that's going to be rupees 3 lakh. And when I take up the proportion, so I can say 0.6, 0.4. So this is my weights. And now I would compute the cost in percentage. Now since both are debt, I will have to use the formula for KD. Now you have to think, since the start of the explanation I'm telling you, KD, am I supposed to calculate for redeemable, irredeemable? No life is given, so we will go for irredeemable. Okay, then नेक्स्ट एक बार रिडीमेबल पता चल गया, फ्रेश इशू है या एग्जिस्टिंग, फ्रेश इशू, तो फॉर्मूला क्या यूज करेंगे, इंटरेस्ट into 1 minus tax rate by net proceeds. Did you get this? And since we have two types of debts, we can do the calculation 10% here and 16% here. अच्छा, जो आप 10% डेट रेस कर रहे हो वो कितने का रेस कर रहे हो, 1,80,000, तो 1,80,000 के सामने आपको कोई खर्चा करना पड़ रहा है, फ्लोटेशन कॉस्ट कुछ है नहीं, इसका मतलब आई कैन से डिनोमिनेटर में 1,80,000 आ गया, इस पे इंटरेस्ट आपको चुकाना पड़ेगा एट 10%, दैट इज 18,000 इनटू 1 माइनस पॉइंट, व्हाट्स द टैक्स रेट, 50%, तो 1 minus 0.5, and when you solve it, that's going to give you 0.05, which is actually speaking 5%, because cost हमको हमेशा परसेंटेज में चाहिए, so that 0.05 is actually 5%, और वो हम यहाँ पे डंप कर देंगे. Did you get this calculation? Now same goes here. I would say against 16% debt जो मुझे रोकड़ा मिल रहा है वो 1,20,000 है. On this 1,20,000 हम इंटरेस्ट कितना चुकाने वाले हैं, तो on this 1,20,000 at 16% I would be paying 19,200 into 1 minus 0.5, so that's going to give me 0.08, which is actually 8%. So I think this is going to be the values. This is 8, and now weights into cost and sum it up, it will give you the average cost of debt post tax. So this is going to be 3, this is going to be 3.2, 6.2% is weighted average KD. This was the answer to the second point. Sir, why you did not take into consideration retained earnings and equity? Because question was telling me to find out post-tax cost of debt only, nothing else. Hence I ignored it. Now, there are next two things that are to be calculated. The next one says determine cost of retained earnings and also determine the cost of equity. Two things we need to answer. So obviously C point is about calculating KR and KE. Now tell me honestly friends, between the two what are we supposed to first find, KE or KR? Has to be KE, then only you can get KR. So I'll focus first on KE. तो अभी KE में क्या सोचने का, ऐसा सोचने का redeemable ऐसा सोचने का नहीं. For KE only one formula when no information given, that's going to be which one, Gordon's formula. So I'll simply begin like this, as per Gordon's formula KE, अभी ये KE ये फ्रेश इशू करना है या एग्जिस्टिंग है, एडिशनल पैसा चाहिए तो ये तो फ्रेश इशू हो जाएगा, तो KE एडिशनल और न्यू, फॉर्मूला क्या बनेगा, D1 by net proceeds plus the growth. Now I did tell you and I did mention it कि there is a set way to solve this, time tested technique है ये, पहले हमेशा डिनोमिनेटर को पकड़ने का, पहले नेट प्रोसीड्स को पकड़ते हैं, चेक कीजिए कहीं पे इशू प्राइस दिया है, बिकॉज नेट प्रोसीड्स कैसे मिलता है, इशू प्राइस माइनस दी फ्लोटेशन कॉस्ट. प्लीज चेक, डू यू हैव एनीवेयर एनी इंफॉर्मेशन अबाउट इशू प्राइस? नो. नेक्स्ट क्वेश्चन, is this company an existing one or a new one? Tell me, is it an existing one or a new one? It is an existing, क्योंकि उसके पास ऑलरेडी शेयर्स हैं, वो ट्रेड हो रहे हैं 44 पे. इशू प्राइस बोला है कुछ नहीं. Given a choice to you, what will be your best assumption? You will issue the new share at what price? Can I say you will be issuing it at the prevailing market price of rupees 44. तो per share रोकड़ा मिलेगा 44 का. Any flotation cost? No, not given. So we assume it to be 0. So when I have one share will fetch me a proceeds of 44. Check growth rate now. Growth rate. Is growth rate given? Yes, the growth rate given is of 10%. So I can say this is going to be 0.1. अगर किसी तरह D1 मिल जाए फ्रेंड्स तो अपना काम हो जाए. D1 सर D1 तो नहीं दिया है, अरे बट कुछ हिंट दिया है, जरा आप चेक करोगे तो आपको पता चलेगा. They have given us earnings per share. Now they have specified earnings per share. How do you interpret this earnings per share? Will you call it as current earnings or future earnings? Earnings per share, future earnings per share or current earnings? It is current earnings. So if you take this as current earnings, that is E0, आप अगर इस E0 को डिविडेंड पे आउट रेशियो से मल्टीप्लाई करोगे, अगर if you have E0, how much is that E0? 4 rupees. If you multiply it with the payout ratio, what is the payout ratio? 50%. अच्छा, if you take 50% of, ये कल ही सिखाया था मैंने, rather I would say ratio chapter में मैंने आपको सिखाया था. In chapter of ratios, EPS को जब मैं payout ratio से multiply करूंगा, तो can I say what I'll get is dividend per share only. That's going to be D0 because it is PE0, तो ये D0 आ जाएगा. So that's going to be 2 rupees. But in the equation, what do I want? In the equation, what I want is D1. ये तो D0 हो गया. How do I get D1? In D1, what calculation we had to do? I had explained you in the start of this lecture of cost of capital. D1 कैसे मिलेगा? D0 plus growth rate. So you just add the growth rate here of 10%. So this will give you D1. So that's going to be 2.2. So I say now my numerator is 2.2, my denominator 44 plus 0.1. So that's going to give me the KE. That's going to be 0.15. तो ये मुझे KE मिल गया 0.15. Friends, KR के बारे में कुछ information दी गई है हमें. KR. So this D1 has been considered from here. KR, since no information given, we say since no info given, we assume KR equals KE equals 15%. Okay, so this is 0.15, which is actually 15%. I hope you guys followed. So when no information, we can straight away take KR equals KE. Okay, now the last one, that is the D point. They say calculate the overall weighted average after tax cost of additional finance. Overall cost of capital पूछा उन्होंने. That means I would say the heading calculation of weighted average cost of capital, that is WACC. Apply brains and tell me. You are supposed to tell me I should write what? Using which weights? Calculation of WACC using which weights? Bolo, bolo, bolo. Has to be marginal value because these are additional funds. So we have additional funds. So using marginal value weights. Now whenever you have to calculate WACC, whether you use book value weights, market value or marginal value, you have to prepare a table. So that table will have sources. Then you have the amounts, weights, cost 10%, weights times cost, the WACC. चलो sources अभी आप मुझे बताइए यहाँ पे क्या क्या sources लोगे आप. Overall cost of capital calculate करना है. So that's going to be 10% debt. Then we have 16% debt. Then we have the equity share capital and we have retained earnings. Now how about the amounts? That you will get it from the first table that sources a pattern. So I can say 10% debt is 1,80,000. 16% debt is 1,20,000. Retained earnings is 2,10,000 and the equity amounts to 4,90,000. So when I take up the total, that's going to be rupees 10 lakh. So if I use these values as the base for computing weights, that's going to be 0.18, this is going to be 0.12, 0.49, 0.21. Okay. Okay, now how about the cost, friends? How will you get the cost? So the cost here is going to be KD का cost ढूंढना है हमने कहीं पे. So this is going to be 5. That one is 8. This is 15 and this is 15. Sum of the products of weights times cost will give me the WACC, that is going to be KO. So if I now do the calculation, I can say that's going to be first one 0.9. Yes, I think some values here we can write it. This is 0.9, this will be 0.96, 0.49. So that's going to be 7.35. That's going to be 3.15. When you add it up, that's going to give you 12.36%, which becomes your KO. I hope you guys followed. So this becomes my cutoff. That's going to be KO. Is it okay? Now what does this signify? 12.36%. How would you interpret this? ये जो पैसा 10 lakh rupees एडिशनल आप रेस कर रहे हो, अरेंज कर रहे हो किसी न्यू प्रोजेक्ट के लिए, वहां से यू हैव टू एंश्योर दैट यू अर्न एवरी ईयर एटलीस्ट 12.36% to satisfy the claims of the investors. Did you get this? So this sum was on the basis of marginal value weights. I hope everyone has followed. So this was question number 4 for you guys. Question number 6. Now this question number 6 is a one that I would suggest that you please do refer it during the exam time. So let's read this sum, question number 6. ABC Limited has following book value capital structure. So tell me friends, this money is already raised or are we going to raise? These are book value capital structure. That means, can I say these funds are already raised? We have equity share capital. We have reserves and surplus. 10.5% preference shares. And then we have 9.5% debentures. 8.5% term loans from financial institutions. The debentures of ABC Limited are redeemable after 3 years and are quoting at 981.05 per debenture. The applicable income tax rate for the company is 35%. The current market price per equity share is rupees 60. Prevailing default risk-free interest rate on 10-year Government of India Treasury bond is 5.5%. The average market risk premium is 8% and the beta of the company is 1.1875. The preferred stock of the company is redeemable after 5 years is currently selling at 98.15 per preference share. Required: calculate the weighted average cost of capital of the company using market value weights. Define the marginal costs of capital schedule for the firm if it raises 750 million for a new project. The firm plans to have a debt of 20% of the newly raised capital. The beta of a new project is 1.4375. The debt capital will be raised through term loans. It will carry interest rate of 9.5% for the first 100 million and 10% for the next 50 million. So again here in this sum there are two parts that are to be answered. Let's concentrate on the first one. It says calculate weighted average cost of capital of the company using market value weights. Clearly bola hai, use market value as weights. So let's do that. So whether it is market value, whether it is marginal value, whatever it is, you have to prepare a table. So my heading will be calculation of WACC using market value weights. Now Whenever you have to calculate WACC, I'm harping the same tone again and again. I'm telling you that we have to prepare a table. The table will have how many columns? It will have 5 columns. So the first one is going to be for sources. Then we have the amounts. Then we have the weights. Cost in percent. Weights times cost gives me the WACC. अब sources में my suggestion to you would be, instead of going row wise, go column wise. First fix all the columns rather than going row wise. So let's check the sources. If you see, you will come to know that we have equity share capital. Now we are following market value weights, friends. Market value. Should we write retained earnings? No, because when I'm going to write market value of equity capital here, retained earnings usme aa jayega, so no need to write that. Check what is the next source of finance, that is 10.5% preference shares. So we have 10.5% preference share capital. Then we will leave one line and then we will write 9.5% debentures and leave one line again and then 8.5% term loan. So after every head, ensure that you leave one line. So my first column is ready. Retained earnings I have ignored because of only one reason, because we are following market value weights. Okay. Ab amounts. So amounts, we have to take market values of each source of finance. So I would say this is 150 million shares into rupees. What is the market price of one equity share? It's rupees 60. So that will give me market values. Preference shares. There are how many preference shares? 1 million shares and one share. Is its market value available? Yes. It's trading at 98.15. Then we have debentures. What's the value number of debentures? 1.5 million debentures. And one debenture is worth rupees 981.05. The term loan will not have any market value, so you just have to write its book value, that's 500 million. I hope you are following what am I doing here. Now, the moment I have written these values, I can just take the total here. So this is coming to 9,000. This is 98.15. So this is 1471.575, and when I'll now take up the total, this is 11069.725. Now using these values, I will be computing the weights. These weights arrived will be termed as what? The market value weights. So this is coming to 0.81. This is giving me 0.01. This is 0.13. So when I take the total, this is 0.82, 0.95. So we can make this as 0.05. So we have calculated the weights. More than 50% of the job now is done. The only place where we have to actually apply brains is in computing the respective cost. So let's think about the cost. Let me go with KE first. Now, I told you that first priority would be given to Gordon's formula. Now check in the question anywhere, do you have P0? Yes sir, P0 is given 60. Check anywhere, do you have any information about growth rate? Growth rate. I doubt, that was not given. Any information about D1? No. That means Gordon's formula can't be applied. Rather, in this sum, if you notice, they have given us information about beta factor. So we have the beta factor, and using that beta factor, we can calculate the KE. So I can say as per CAPM, how do you calculate KE, friends? It is returns from the risk-free securities plus the returns from market minus returns from risk-free securities into the beta factor. Up, check. How much is the returns from risk-free securities? If I am not mistaken, the returns from risk-free securities are 5.5%. The returns from Government of India Treasury bonds is 5.5%. So this is 5.5 plus. Now, if you notice, they have given us market risk premium. Premium is given. It's not market returns. It is risk premium. And that risk premium, so we have the net of amount here. Maximum people will do mistake here. They will take 8 minus 5.5. That would be wrong, because what they have done is they have already given me this net figure 8. And what's the beta? The beta of this project is or equity is 1.1875. So when I do solve it, I can get the value here. So that's going to be 15%. So this becomes my KE. So using CAPM approach, we found this here as 15%. Did you get this? Okay. So we now have this as KE. Now check. We have to think about KP. Friends, tell me KP, that is cost of preference share. Tell me, are the preference shares here redeemable or are they irredeemable? Check please. Preference shares, are they redeemable or are they irredeemable? You would realize that counting from today, these preference shares are having a life of, I think, some 5 years. Yes, they are redeemable after 5 years. So I have to use that formula, preference dividend including DDT plus redemption value minus market value. Why am I writing market value? Because these are my existing preference shares upon N, the whole divided by redemption value plus market value by 2 into 100. This is what we need to do. Had it been a fresh issue, then wherever market value I have written, I would have substituted it with net proceeds. So preference dividend. What's the face value of one preference share? 100. Rate of dividend is applied on the face value. तो वो कितना हो जाएगा? 10.5 plus. What's the redemption value? Redemption value. Now, if you notice in the question, nowhere redemption value has been specified. So we can say redeemable value, the redemption will be at par minus 98.15 by, now counting from today, the life is 5 years. So that's going to be 100 plus 98.15 by 2. And since it is to be calculated in percentage, we multiply it with 100. So what we can now do is we can find out these values. So that's going to be 100 plus 98.15 divided by 2. So the denominator becomes 99.075. So that's going to be 100 minus 98.15 divided by 5 plus 10.5 divided by 99.075. So we now have 10.97%. So this is 10.97%. That's going to be my KP. And what's the use of this? I can write it here as 10.97. Did you get this? Okay. Now, the next source is the debt, the debentures. Now, debentures are also in this sum redeemable. Now, if debentures are redeemable, what formula would I apply for debentures which is redeemable? Interest into 1 minus tax rate minus redemption value, I would say rather plus redemption value minus market value by N. The whole is to be divided by redemption value plus market value by 2. Why we have not multiplied preference dividend here with 1 minus tax rate? Only because of one reason, because that's already after tax. Now what's the face value? If you notice, the market value of the debenture is 981.05. So we can say face value will be 1000 and it's already given in the table. So 1000 पे 9.5%, मेरा 95 rupees का interest हो जाएगा, and the applicable tax rate is 35%, plus nothing specified. The redemption value is 1000 minus 981.05 by 3. The whole is to be divided by 1000 plus 981.05 by 2 into 100. So now, so 981 so the denominator now here is 990.525. So that's going to be plus 6.32. So here I'm getting 6.87%. That's going to be my KD, 6.87%. Did you get this? The last source of finance that we have now is a term loan. So these are for debentures, and we now have computing KD for term loan. अच्छा, check. Term loan, is it repayable anywhere? ऐसा कुछ बोला है? Term loan is repayable, redeemable, ऐसा कुछ बोला है? नहीं. So we will be using the formula of irredeemable one, that's interest into 1 minus the tax rate upon, now these term loans are existing one, so we will write market value. But to our surprise, we know that term loan will not have any market value. So whatever is the value appearing in the books, that itself will be considered as its market value. So we say 500. The rate of interest is 8.5%, so that's going to be 42.5 into 1 minus 0.35 into 100. That's going to give me the value. So that's going to be 42.5 into 0.65 divided by 500 into 100. So that's going to give me 13 point. What's the cost? No, that's going to be some mistake here. So that's going to be 0.65. So this is 5.525%. So this is 5.525, and that's going to be written here as 5.525. Sum of the products of the weights and cost is going to give me the WACC. So you can check it now. So this is 13.43%. So this becomes now my KO. So if you notice, this becomes the answer to the first point. Calculate the KO using market value weights. So the KO for this organization using market value weights will be 13.43%. There is one more part that is remaining, so we can discuss and finish off that part as well. That's going to be the second part. Now, the second point says what? The second point says define the marginal cost of capital schedule. Now, how would you interpret this word define? Define here would be ascertain. Ascertain the marginal cost of capital schedule for the firm if it raises 750 million for a new project. So the question says we are going to raise 750 million for a new project. That means if it is a new project, which weights are you going to follow? Obviously, we'll have to follow which weights? marginal value weights. Then the firm plans to have a debt of 20% of the newly raised capital. The beta of the new project is 1.4375. The debt capital will be raised through term loans. It will carry interest rate at 9.5% for the first 100 million and 10% for the next 50 million. So we have to calculate WACC again, but to calculate this WACC, we will have to use marginal value weights. So we have marginal value weights. अच्छा, इस प्रोजेक्ट के लिए कितना रोकड़ा चाहिए? I think 750 million. अब ये 750 million हम लोग कैसे अरेंज करने वाले हैं? क्वेश्चन ने बोला है कि whatever is the capital required, 20% is by way of debt. So can we safely conclude 80% would be by way of equity? So 0.8 would be equity capital. So I would say this way, that means if I am going to erase 1 rupee, 0.8 would be equity. It means that makes up 600 lakhs or 600 millions like. Now then thereafter they say that again here the loan is not available at flat rate, it is available at slab rates. That means I would say अगर आप 100 million loan ले रहे हो तो you will be charged interest at a different rate, that's going to be 9.5%. And in the next case it's going to be 10%, so that's going to be 50 million. So when you calculate the weights, that's going to be 0.13 and I guess 0.07. That's making up the total to 1. Now the first source is a debt, and the debt here nothing has been specified, so we will be taking it as which debt? It's going to be irredeemable one. So tell me the formula. Interest into 1 minus the tax rate by what? It's going to be by net proceeds. Why? Because these are additional funds, hence it is going to be net proceeds. So now here what we will do, we will check now. There are two loans, 9.5% loan and then we have 10% loan. So 9.5% में हम लोग check करते हैं, we'll be getting a loan of 100 million. The interest that I'll pay is 9.5. 1 minus 0.35, and here 50 million is what I'll get. So 5 I will pay interest into 1 minus 0.35. So when I do this calculation, it will give me the respective cost. So you have to calculate in percentage, so multiplied with 100. Here also you multiplied with 100 to get the answer in percentage. Then once you get this, then you can again use CAPM approach. Because for calculating that KE, again we have to make use of CAPM approach, and the formula for KE will be RF plus RM minus RF into the beta. Now the risk-free security won't change, it will still stay at 5.5%. The difference is 8% and the beta is 1.4375 if I'm not mistaken. That's going to give you the KE for the next case. So let's do compute the values and then we can finish off this part of the sum. So here it's going to give you 6.175. So here this is going to be 6.175. So here it's going to give you 6.5%, and for the KE that's coming to 17%. Now this figure we can write it here as 17 and then we can get the KO. So now wherever the 750 million is going to be used, this is what you need to earn. So we would say so this is coming to 14.86% my overall cutoff. यानी कि ये 750 million अब हम जहां भी invest करेंगे उस 750 मिलियन के लिए कट ऑफ आ गया 14.86%. So this was solution to question number 6, and this was, I would say, the only unique point here was computing this KE, and obviously cut-off calculations are the only thing this chapter is dependent about. So redeemable, irredeemable, वो सब सोचने का है आपको, and then you need to solve it. ठीक है? So this was the discussion of question number 6. Thereafter, now the next part of discussion that will remain in this chapter is calculating the growth rate. So we need to learn formulas for growth rate. Thereafter, we will be discussing the capital structure theories, which can come as short notes in your exam. So we'll take that in a while. Okay, so we have two segments that are still remaining. One is calculating the growth rate, and then we have the capital structure theories. So let me take up the first point, that is calculating the growth rate. You know, friends, in Gordon's formula, you know, we have learned this formula. As per Gordon's formula, KE is D1 by P0 plus the growth. अब जितने भी सम्स हमने अब तक सॉल्व किए हैं उसमें ये ग्रोथ रेट हमेशा अवेलेबल था. So what if this growth rate is not given? Then how do you compute this growth rate? So let's understand that computing the growth rate. I'll take a couple of examples that can give you a better idea of calculating the growth rate. So you need to first check, is growth rate given? If yes, use it. If not, then you just, recollect these things that I'm explaining with you. Suppose I'm giving you data of dividend per share. I'm giving you data of dividend per share of a company of the past 4 years. I'm giving you last 4 years dividend data. Let's take it this way. This company in year 1 gave a dividend of rupee 1. It gave a dividend of 1.1. Then the dividend increased to 1.21, and then it was 1.331. So my question to you guys is very simple. Look at this past dividend data. What conclusion do you draw? You would realize that each year the dividend of the company is increasing. Now if it is increasing at what rate? So let's check. When I compare the dividend of year 1 with that of year 2, I realize that the increase is by 0.1. So if I calculate in percentage terms, it is change upon the original in 200, and that's giving me 10% rise. If you now notice dividend of year 2 with that of year 3, even that has increased. It has increased by 0.11 upon original 1.1 in 200. That's going to give me again 10%. If you compare year 2 dividend with that of year 3, you would again realize that this is going to be a rise by 0.121 upon original 1.21 into 100. That's going to give you 10%. So what conclusion do you draw? In the past, each year dividend increased by 10%. So if every year dividend has increased by 10%, in the upcoming years, you would expect your dividends to rise by what rate? Again, 10%. So we can say growth rate here becomes 10%. So one way to calculate growth rate is look at the past dividend pattern, the past track record. You will come to know the growth rate. Now, example 2 now. Now in this example, again I'm going to give you dividend of past 4 years. But let's assume this time the dividend was 1.06, 1.10, and let's take it this way, 1.18. Now, if you now notice, friends, here also the dividends of each years are increasing. But if I compare and if I calculate the growth rate, then I realize that this is going to be an increase by 0.06 by 1 into 100. That's going to give me 6%. तो यहाँ पे dividend grow हुआ है at 6%. If I compare dividend of year 2 with that of year 3, I realize that it's going to be an increase by 0.04 by original 1.06 into 100. That's giving me how much? So that's 0.04 divided by 1.06%. So that's an increase by 3.77%. Now if I compare year 3 dividend with that of year 4, then it's an increase by 7. So this is going to be 0.08 upon 1.1 into 100. That's going to be an increase by 7.27%. So now if you notice, the difference between this example and this example is here dividend of each year increased by 10%. So that was a constant growth rate. Here if you notice, the dividend is increasing, but the increase is not at a constant rate, but it is at an uneven rate. Somewhere in Gordon's formula, I did mention that the growth rate in that Gordon formula is assumed to be a constant growth rate. Now, if this is the past track record of this company, what you can now assume? The dividend is growing at an uneven rate. I want a constant growth rate. So here we can simply take average of the growth rate, and we can assume that whatever is the average growth rate in dividend of the past 4 years, that is what we expect to receive in future. So now I will take like this: 6 plus 3.77 plus 7.27%. So when I add it up, it's 6 plus 3.77 plus 7.27 divided by 3. So my average growth rate is coming to 5.68%. So now I would expect that my dividends of the company would grow at an average rate of 5.86%. So that is the average growth rate. That was my second example. So one way to calculate growth rate is look for past dividend data. So if past dividend data suggests that the dividend is growing at a constant rate, that itself becomes the expected growth rate. If the past track record shows dividends have grown at an uneven rate, you can very well take an average of the growth rate. That will also give you the average of growth rate, and that you can expect that itna mujhe future mein jo dividends milenge, that should grow at this rate, 5.68%. Let me take up the third example, the final one, and then I would give you the formula also for calculating growth rate. Suppose now I give you dividend for the year 2010. Now, and I give you dividend of year 2014. So that's going to be 14 rupees. So if you notice, friends, the difference between the first two examples and this example is, in between dividend मैंने आपको दिया ही नहीं है. In between, that is 11, 12, 13 का dividend I have not given. I have given you dividend for the year 2010, and I have given you the dividend directly of 2014. In between dividend, I have ignored that information. Now that information is not given, and if I tell you what is a growth rate, so you can't simply take this way, sir, 4 rupees divided by 10 into 100, 40% is growth rate. No, that's wrong. If you understand, friends, this dividend is growing every year at 10%. So this growth rate is actually a compounded growth rate. I would say compounded annual growth rate, CAGR, we can say this is a compounded annual growth rate. So when in between data of growth rate is not given, then how do you calculate that? You can very well make use of compound interest formula. So the formula is A equals P into 1 plus R, the whole raised to the power of N. This is the compound interest formula. In this rate is actually going to be nothing but our growth rate. You can substitute that rate. That rate is always compounded rate of return. So that is going to be my growth rate. So how much is the dividend of 2014? That becomes amount here. That's going to be 14. How much is the principal? So we have 10 into 1 plus the growth rate. I don't know the growth rate. And the life between the 2 years is going to be 4 years. So when I solve it, I can get the answer of growth rate. So it's 14 divided by 10. That's going to be 1.4 equals 1 plus the growth rate raised to 4. So now I want fourth root of this number of 1.4. So we need to press root sign 2 times. So if it's a fourth root, it's 2 times. So when I press root sign for 2 times, this is 1 plus growth rate as 1.0876. So 78 rather I would say. So 0.78. And now my growth rate becomes 0.0878. That is actually 8.78%. So this is my growth rate. So if you now understand, I have given you 3 examples for calculating these growth rates. One, dividend grows at a constant rate. Other, dividend grows at an uneven rate, so take the average. If in between dividend is not given, you can simply make use of the compound interest formula, and that can give you the answer. So we have calculation of growth rate. Calculation of growth rate. Okay. So these are few examples. You may note it down, these examples, and then I will give you the formula for calculating the growth rate. Okay. So you need to check first, friends, which information is provided by the question, and accordingly you can take a call whether you should follow this pattern or should you go for the formula. Okay, so let's take up the formula. I'll explain you the formula. There is one formula for calculating growth rate. We will be discussing that again in the chapter of dividend policy. So here I'm just giving you the formula. Could you please tell me when can the earnings of the company grow? What is your opinion? आपको क्या लगता है कंपनी का earnings कब grow हो सकता है? Whenever company would retain the profits and whenever it is again utilized, which can help them to earn some return, then the earnings of the company will grow. It goes like this. Suppose मैंने आपसे 1 लाख रुपया रेस किया, मैंने आपके लिए 20% कमाया. So on 1 lakh I have earned 20%, that is 20,000, and I distributed, say let's presume 40% of the profits. यानी मैंने आपको 20,000 में से 8,000 रिटर्न दे दिया. अब मैंने मेरे पास रखा कितना? 1,12,000. अब since growth rate is assumed to be constant, I have to assume certain things also to be constant. So let me presume I earn the same rate of return on your funds of say 20%. तो अब जो आपका पैसा मेरे पास पड़ा है वो 1,12,000 है. And for your kind information, if I earn 20% on that 1,12,000, that comes to 22,400. So if you notice, first year में मेरा earnings था 20,000, वो 20,000 22,400 बन गया next year के लिए. Why did it increase? It's only because of one reason, friends. Profits are getting retained and they are getting reinvested. That's the reason for the dividends of the company also to grow if you follow a constant payout ratio. So if I say I want to calculate growth rate by way of a formula, तो growth rate कैसे मिलेगा? G. By way of a formula, it is nothing but retention ratio. Profit is getting retained. Now this retention ratio is denoted by letter B, and not only it is retained, but then it is reinvested, and that will help the company to earn particular rate of return. So retention ratio into return on equity, that is denoted by letter R. This becomes a formula for growth rate. So actually speaking, G is a product of B into R. Profit, if it is retained and if it is reinvested, the earnings of the company will grow, and if the earnings of the company will grow, you keep the same constant payout ratio, your dividends will also grow. So this is the formula for growth rate. Now I have an alternate way to get the formula for growth rate. So let's understand that formula for growth rate. Now since we say G is equal to B into R, what is the formula for retention ratio? Chapter of ratios I have discussed. What's the formula? Retention ratio is nothing but EPS minus DPS upon EPS. This is the formula for retention ratio. How do you calculate return on equity? I want return on something. That something becomes the denominator. So ये हो जाएगा equity. You can call it now. If there is no preference capital, I mentioned it somewhere in ratios. When there's no preference capital, equity or shareholders funds or equity shareholders funds, everything is going to be the same. So this is equity, which we will term it as equity shareholders funds. As equity shareholders, why would you invest money? Obviously to earn profits. So the profits that you earn will be earnings for whom? For equity shareholders. Now if I simplify this formula, you tell me friends, will I get a different answer or a wrong answer if I write the formula like this? Earnings for equity shareholders divided by equity. Now if you tell me friends, if now I divide this numerator with number of equity shares, and if I divide this denominator also with number of equity shares, will I get a different answer? No, I'll still get the same thing. So the formula will be EPS minus DPS by EPS into earnings for equity shareholders. When you divide it with the number of equity shares, क्या मिलेगा? फिर से मिलेगा EPS. Equity, which is nothing but equity shareholders funds, when you divide it with the number of equity shares, क्या मिलेगा? We know equity shareholders funds कहाँ पे मिलता है? Which is the document that you refer? You refer the balance sheet, and if you refer the balance sheet, that is equity shareholders funds, if you divide it with the number of equity shares, जो value मिलेगा वो होगा book value per share. Now when you cancel this, EPS is getting cancelled here. So summary here is EPS minus DPS upon book value per share, and growth rate, since it is calculated in percentage, you can multiply it with 100. So there are two ways to calculate growth rate. G is equal to B into R, and G is EPS minus DPS upon book value per share. Is it okay? So first you need to check, do you have past dividend data? If yes, extrapolate that and you can get the answer. If it is going to grow at a constant rate, simply take that itself as the rate. If it is uneven, take average. Third is, if 2 years dividend data is given, in between data is missing, then you can again calculate growth rate by using compound interest formula. Then we have the formulas as well for calculating the growth rate. So you can please note down these formulas that can be asked not just in this chapter. It's possible that it can even come in the chapter of dividend policy. So you can just make a note of this. Okay friends, so the next point and the last point that we have to discuss of this chapter is the capital structure theories. So we now have to understand those capital structure theories. This part of capital structure theory is important for two reasons. One, you can get short notes in the exam out of this point. Second, even sums can come in the exam. So my suggestion is, please do pay attention to all the discussion that we are going to do now here regarding capital structure theories. So let me give the heading to the concept, capital structure theories. Capital structure theories. Now, let me ask you one question. Think about that and then give me the answer. What's going to be the scenario? First, tell me, the question that I would like to raise is, will change in capital structure change the overall cost of capital? That is weighted average cost of capital. Chalo, socho. If we change the capital structure, will changing the capital structure change the overall cost of capital? So what is your viewpoint? Now, when I raise this question in the class, people would definitely say, yes sir, if we change the capital structure, it means the proportion would change. If proportion would change, then I would say cost will get affected. So definitely changing the capital structure does affect the overall cost of capital. Now, the way you guys have a viewpoint that yes sir, changing the capital structure does affect the overall cost of capital, there are two theories which also have the same viewpoint. The two theories that are having the same viewpoint is, one is the net income approach and the other is the traditional approach. Now, what is the viewpoint of these two theories? The viewpoint is, if at all we change the pattern of arranging money, the overall cost of capital, since it is dependent on capital structure, that will also undergo change. Now, there are two set of theories which have complete opposite viewpoint. As per these two theories, you arrange money in any manner you want, any pattern you want, KO of the company is unaffected. WACC is unaffected because of pattern of arranging the money. So here the approaches are having a complete opposite viewpoint. पैसे कैसे भी arrange करो, KO remains the same. अच्छा, कौन सी theories हैं ये? So one is the net operating income approach, also called as NOI approach. This one is our NI approach, and the other is the traditional approach, or rather not traditional, I would say. This is NI approach, NOI approach, and then we have the MM approach, Modigliani-Miller theory, or MM hypothesis, or MM model. क्या viewpoint है इन theories का? The viewpoint of these theories is, you arrange money in any manner you want. KO is completely independent to the capital structure. Now friends, this theory says, yes, if you change the capital structure, KO will change. ये बोलता है तुम पैसे कैसे भी arrange करो, KO is unaffected. Now, if these theories consider capital structure as relevant in determining KO, and for different capital structures, can I say we will have different KO. So we can call these as our variable WACC theories. So we can call these as variable WACC theories. Now, as per these theories, can I say whether I change the capital structure or not, KO is always going to remain constant. So we can call these theories as constant WACC theories. Constant WACC theories. Arrange money in whichever manner you want, WACC is constant. Now, if these are variable WACC theories, it means if you change the capital structure, KO keeps on changing. क्या ना से उन सब different capital structures में से एक ऐसा capital structure होगा जहां पे KO सबसे minimum होगा. Since these capital structure theories, they are variable in nature, that is change the capital structure, ये change होगा. अभी अगर ये change होगा तो कहने से there will be one capital structure where KO will be the least. Yes, so that capital structure will be termed as optimum capital structure, best capital structure. मतलब we can say here there exists an optimum capital structure and optimum capital structure is that where KO is minimum. Because for different capital structures I will be having different KO. There will be one KO will be the least, and the KO which will be having the least value, that is the best KO, and there my capital structure will be considered to be the best one, the optimum one. अब यहाँ पे बोला गया है तुम अरेंज करो कैसे भी. If you arrange money in whichever manner you want, KO remains unaffected. That means if I now ask you which one would be the best capital structure, any capital structure would be the best. Why? Because KO is going to be the same. So we can say there exists nothing known as optimum capital structure as every capital structure is optimum. समझा? So this is the basic argument that we are placing now. Changing the capital structure does affect the overall cost of capital. Changing the capital structure does not affect the overall cost of capital. The theories are of the view that changing the capital structure which will affect the KO are NI approach and traditional approach. Contradict करते हैं जो पूरा point है, that is NOI approach and MM approach. So we have variable WSCC theories, constant WSCC theories. As per these theories, there will exist something known as best capital structure. And the best capital structure as per these theories will be the one where our overall cost of capital will be minimum. Since for any capital structure KO remains constant, every capital structure is optimum in itself. Now all these theories, friends, have proved their point. Every theory proved their point, and in proving their point they have taken numerous assumptions. But there are assumptions which are common for all the theories. So I'll discuss all the assumptions that are common to each and every theory. Then there are specific assumptions related to the respective theories. So now let us take up the general assumptions, which I can call them as common assumptions. So let's discuss those common assumptions. So we have general assumptions. Now these assumptions, why am I discussing? I'm basically more interested in discussing this MM approach. बाकी सब अगर आएंगे भी तो भी usually you can expect theory from that, but I'm more interested in discussing this MM approach. So I'll be discussing these general assumptions. I'll give you the overview about the other theories, how they work, and then we'll be discussing exhaustively the MM model, the MM approach. But what are the general assumptions taken? The first assumption taken, which is common for all the theories, is that there are going to be only two sources of finance. There are only two sources of finance. Now which are those two sources? One is debt and the other is equity. There are two sources of finance, debt and equity. This is the first assumption. Now when I say there are only two sources of finance, debt and equity, what is the other conclusion that you draw? It means we don't have any preference shares and we do not have any retained earnings. This is my first assumption. Second, there are no taxes at all, so we don't have any taxes. Third, there is 100% payout ratio. So we have 100% payout ratio. Acha, when I say there is 100% payout ratio, what does it mean? There is going to be no retention at all. That's the reason why यहाँ पे two sources होगा ना, debt and equity. There is no preference, though there is no retained earnings. Next. Now, the total assets of the company are given and they are assumed to remain constant. So they say total assets of company are given and are assumed to be constant. Now, what does it mean? Total assets of the company are given and they are assumed to be constant. Iska matlab, your assets under any circumstance, if you change your capital structure, your assets are not undergoing any change. And when your assets do not change, can I say your sales will remain same? And if your sales will remain same till EBIT, everything will remain same. It means there will be no growth in EBIT. So I would add up one more, no growth in earnings. So these are basic assumptions, and then every theory has taken its own assumptions. What we'll now do is, for understanding all these theories, we need to take up formulas. There are specific formulas which we need to discuss for these respective theories. Now, before I begin with those formulas, I need to make you guys understand an income statement. So we have to learn an income statement that is going to be used for these capital structure theories. So let's understand the income statement. Now, the income statement for capital structure theories will start with EBIT. From that, we will now deduct the interest. So we have EBIT, then we deduct the interest. When we deduct the interest, this part of the income statement I have learned and I have taught you in the chapter of leverages, I have taught you in the chapter of ratios, capital structure. From the EBIT, when I deduct interest, the resultant becomes EBT. If you notice, there are no taxes. So if we don't have any taxes, can I say जो EBT है वो ही EAT हो जाएगा? अब there is no preference capital as well. तो can I say जो भी EAT है वो ही earnings किसके लिए हो जाएगा? Earnings for whom? For equity shareholders. And there is 100% payout ratio, friends. So can I say that itself will become the dividend? So the formula is very simple and the income statement is very simple. EBIT minus interest is nothing but dividend. EBIT minus interest is going to be dividend. Now, as I told you, I will have to make you explain some formulas. For that, I will need to erase this thing first. So if possible, you can just copy down these things. The reason being I'm telling you is, you know, if you get a short note in the exam which says, write a short note on NI approach. So if you write a short note on NI approach, this is going to be the NI approach. So you will write this way. NI approach is of the opinion that changing the capital structure will definitely change the overall cost of capital. And this theory is a variable WACC theory. As per this theory, there exists an optimum capital structure, and an optimum capital structure will be that where overall cost of capital will be minimum. This point they have proved by taking this following assumption. So now if this time you get a theory which says NOI approach, so NOI approach is of the view that changing the capital structure does not change the KO. It's a constant WACC theory. And there exists, as per this theory, nothing called as optimum capital structure, as every capital structure in itself is optimum. This point has been proved by taking. Matlab, what I can tell you is, if a short note comes, you can write all these things in the form of short note. So now I'll explain you some formulas for the capital structure theories. Meanwhile, you can just take a screenshot of this thing so that when you revise, it can be of use to you. Now, let us understand some formulas. We need to discuss some formulas that are related to these capital structure theories. So I'll explain you those formulas, and then I'll tell you what exactly is the viewpoint for each and every theory. Okay, so how do you calculate the WACC, friends? What we did is we took sources, then we have the amounts, then we have the weights, then cost in percent. Weights times cost gives you the WACC. Now, there are going to be only two sources here. One is going to be the debt, the other is going to be the equity. Now, let us presume that you guys, the debenture holders, are say giving us 2 lakh rupees, and equity shareholders, the value is 8 lakh rupees. So between book and market values, I told you we will be giving preference to market values when no information is given. So this is going to be the market value of the company. Now if I use these values as the base to compute the weights, it's going to be 0.2 here, and that's going to be 0.8. Now you tell me, friends, between debt financiers and equity financiers, who takes more risk? Between debenture holders and equity shareholders, who takes more risk? Can I say equity shareholders? So who would expect more returns? Obviously equity shareholders. So let's presume equity shareholders desire 20%. Now whatever equity shareholders desire, can I say that is KE to me? That is cost of equity. Let's presume debenture holders expect 10%. So that is also cost of equity to me. So this is going to be 2, this is going to be 16, and I can say 18% is my KO. Now, I am interested in making you guys understand few formulas. So what's that? First formula is to understand value of the firm. Worth of the firm, value of the firm, which is denoted by letter V. अच्छा, अभी आप मुझे बताइए यहाँ पे वैल्यू ऑफ द फर्म कितना होगा? वर्थ ऑफ द कंपनी, वैल्यू ऑफ द कंपनी कितना होगा? द वर्थ ऑफ द एंटायर फर्म, द एंटरप्राइज वैल्यू, कैन आई से इज नथिंग बट वैल्यू ऑफ दिस डेट, वर्थ ऑफ दिस डेट प्लस वैल्यू ऑफ इक्विटी. सो द फॉर्मूला विल बी वैल्यू ऑफ डेट प्लस द वैल्यू ऑफ इक्विटी. Now when I'm using the word value, the word value is actually nothing but market value. So I can say V is equal to D plus E, or you can say E plus D. Now if in this I tell you, let's develop the formula for calculating E first. That is nothing but equity. How do you get the equity? Now tell me, friends, if I go by this example, you guys are equity shareholders. You guys are expecting what rate of return? So you would say, sir, we are expecting 20%. So in percentage, you are expecting 20. In rupees, sir, in rupees, that means on this 8 lakh, we are expecting 20%. So in rupees, we expect 1,60,000 by way of, can I say dividend? Because here, whatever is returns for you is by way of dividend. So on this 8 lakh, you are expecting 20%. So I would say you guys are expecting 1,60,000 rupees by way of dividend. अच्छा, तो ये dividend कैसे मिला? तो can I say you take dividend as E into KE. Whatever is the value of equity into KE, it's going to give you the dividend value. So if I do calculate this, it gets like this. 8 lakh pay, we are expecting 20%. So we are expecting in rupees 1,60,000. So if you are expecting 1,60,000 in rupees, so if I now tell you transposition this formula, do ulta pulta to this formula and get me the formula for E now. How will you get E? Can I say E is going to be nothing but dividend by KE. E will be nothing but dividend, just divided with KE, you will be able to get the value of equity. So you know this method which I'm following to find the value of equity, it is called capitalization method. Which method? Capitalization method. We are capitalizing this dividend with KE to find the value of equity. We are capitalizing this dividend to find the value of equity. So one way to calculate E is dividend by KE. Alternate way, can I say E can also be calculated as V minus D. So since V is D plus E, so E will be V minus D. That is one way. Alternate way is dividend by KE. Now, if I tell you, let's develop the formula for calculating debt, that is D. Acha, what is the rate of return that you guys are expecting, debenture holders? How much are you expecting? 10%. Now in percent, it is 10. In rupees, can I say in rupees by way of interest on this 2 lakh, you're expecting 10%. It means 20,000. That is by way of interest. तो अगर मैं आपको बोलूं, let's calculate interest. तो friends, can I say interest is going to be nothing but D into KD. अब मेरा debt कितना है? 2 lakh. What is your desired rate of return? Whatever you desire is cut off for me. It is 10%. So I can say you guys are expecting interest of 20,000 rupees. Now, if I tell you do ulta pulta to this formula and through this formula calculate D. So what will be the formula for D, that is debt? D, can I say, will be nothing but interest by KD. Interest by KD. We need to just capitalize this interest with KD to find the value of debt. So we are capitalizing this interest. This is again a capitalization method. कोई भी चीज का value ढूंढना होता है, तो what you need to do is take the variable, divide it with the rate of desired rate of return. So it is interest, which is the profit which the debenture holders are expecting in rupees. So this is their expectation in rupees. Divide by expectation in percentage. We capitalize it, we get D. This is expectation in rupees. Divide by desired rate of return in percentage gives you E. So at present we have learned three formulas. V, which is equal to E plus D. E is dividend by KE and D is interest by KD. There is one more way to calculate V here. Now if I plot these values and write it, so that's going to be 2 lakh plus 8 lakh, that is 10 lakh. So that's the value of the firm. There is one more way, friends, to calculate this value of the firm, worth of the company, V. Alternate way bhi hai. Kaise? Now let's understand this. For that I will require the income statement. We have one more way to find the same answer of rupees 10 lakh, but in an alternative way. Kaise? So let me prepare the income statement. So we have EBIT minus the interest. Can I say that gives me dividend? EBIT minus interest will give me simply dividend. I have calculated the amount of dividend. So dividend is 1,60,000. We have calculated the interest as well. That's going to be 20,000. It means, can I say EBIT here is 1,80,000. Alternate way to get V. How can we get that V? Friends, what we have done, this is dividend for whom? Dividend ये किसके लिए है? Equity shareholder के लिए. So if this dividend is for equity shareholders, what did we do? We capitalized it with KE. तो उसने मुझे क्या दिया? E. 160 by KE, it gave me E. ये इंटरेस्ट किसके लिए है? कैन आई से डिबेंचर होल्डर्स के लिए. तो अगर मैंने ये KD से कैपिटलाइज किया तो कैन आई से आई गॉट D. अच्छा, ये EBIT किसके लिए है? Can I say for all the investors? That is, it is for debenture holders also, it is for equity shareholders also. So if this is being capitalized with KE, this is being capitalized with KD, can I say this will be capitalized with KO? And if you do that, you will get the value of the firm. If you check, you can get to know the same answer. So V, if I want, I can say it's EBIT by KO. V equals EBIT by KO. And if I do that calculation, you will realize this is 1,80,000. And how much is the KO in my example? 18%. That's obviously nothing but 0.18. So this is giving me a value of rupees 10 lakh. So if you notice, the answer of 10 lakh here and the answer of 10 lakh here is the same. So I'm telling you there are two ways to calculate V. One is E plus D, other is EBIT by KO. Now this formula of V and this formula of V will give you the same answers if there are no taxes. That means this formula works if there are no taxes. But sir, you only said in one of the assumption that there are going to be no taxes. Now I would say yes, there are no taxes. But under MM approach, there are two situations. In one situation, there is no tax, and in the other situation, there are taxes. So you need to be careful at that point of time. So this formula in MM's approach, remaining NI, NOI traditional, there are no taxes. In MM approach, at one part, there are no taxes. Later on, they introduce taxes. So if they have introduced taxes, then if you use this formula, it will go wrong. So if there are taxes, then how do we calculate V? First of all, understand this. Value of the firm as per this formula and as per this formula will be the same if there are no taxes. If there are taxes, this formula would fail to work. So if this will fail to work, what adjustment should I do to this formula so that I can get the correct value? What should we do to this formula so that we get the correct value? Now what we will do, first of all, in this chapter, if I'm not mistaken, I have done one discussion about KO. This KO which we have calculated, tell me honestly, is it before tax KO or after tax? KO is always after tax. मैंने आपको बोला भी था कि KO is always going to be after tax. इसीलिए हमने KD को भी after tax में convert किया था. So if KO here is after tax, how about EBIT? Is EBIT after tax or before tax? You would realize that EBIT is before tax. So can I say there exists a taxation difference? How can you eliminate that taxation difference? One option is, since KO is already after tax, you convert it into before tax. Now anything if it is after tax, if you want to convert it into before tax, क्या करने का? Just divide it with 1 minus tax rate. Other option is you can convert EBIT, which is before tax, to after tax. How can you do that? Simple. Since it is before tax, you can convert it into after tax by just multiplying it with 1 minus tax rate. Did you get this? So V here is going to be EBIT into 1 minus tax rate by KO. Now if there is no tax, the original formula prevails. Now why did I do this EBIT into 1 minus tax rate? Because KO is after tax, EBIT is before tax. So to bring in line with the two, I had converted EBIT to post-tax EBIT. So when there are taxes, the formula for V will be EBIT into 1 minus tax rate by KO. Okay? So this is the formula. And one more point that I would like to discuss here is, can I say there is an inverse relation? There is an inverse relation between V and KO. The moment you decrease your KO, what will happen to V? V will increase. What should be your objective? To maximize the value of the company or to minimize it? Maximize. When can that maximize? Can I say whenever KO is minimum, value of the company would be maximum. So there is an inverse relation between V and KO. So we have discussed 4 formulas. V equals E plus D, E equals divided by KE, then D equals interest by KD, V equals EBIT by KO, provided there are no taxes. If there are taxes, then V is EBIT into 1 minus tax rate by KO, and there's an inverse relation between the two, where KO is less, V will be maximum. Is it okay? Fine. So this was the basics that I would require for all the capital structure theories. So please ink it out if possible, and if you want, you can take a snap of this. Now, so let us discuss the first approach, that is the net income approach. I would like to discuss these two approaches together because, you know, as I told you, we are more interested in the last approach, that is the MM approach. I'll just give you a brief. See, friends, these two approaches, which one? The NI approach and the traditional approach, इनका व्यू पॉइंट क्या है मैं आपको पहले बता देता हूं. तो एज पर दीज टू थियरीज, कोई भी कंपनी का वैल्यू कौन डिसाइड करेगा? It will be decided by the pattern of arranging the money. Just understand this, friends. As per these two theories, कोई भी कंपनी का वैल्यू, that is V, how it will be determined? It will be determined by the value of the equity and the value of the debt. That is what they meant. कि जैसे जैसे आपका proportion of debt equity change करते जाओगे, आपकी कंपनी का वैल्यू चेंज होते जाएगा. But NOI approach and traditional approach, उनका क्या व्यू पॉइंट है? जैसे कि कोई भी कंपनी का वैल्यू उसकी लायबिलिटीज नहीं बट उसके असेट्स डिटरमाइन करते हैं. सो वैल्यू ऑफ द कंपनी इज नॉट डिटरमाइंड by the liabilities but as per these two theories. Which two theories? So I'm talking here about NOI and MM approach. Whereas NI and traditional approach, their view is that कोई भी कंपनी का वैल्यू liability decide करेगा, but NOI and MM are of the opinion that the value of the company, that is V, is always determined by the assets which it has. I would like to just ask a simple question. Ki, how come, sir, assets will determine the value? Let's understand the same with the help of an example. Suppose there are two companies. Let's presume we have TCS and we have TCS1. Both are identical. All the entire stuff about these two companies is the same. So both TCS and TCS1, though we don't have any company called TCS1, but just for understanding purpose, suppose both companies are having the same business. Both companies are having the same business. They're having the same level of the assets, doing the same business into the same activity. Amount of investment in assets is the same. Capital employed is the same. Everything about the two business is the same. Now, you just think and tell me, NOI approach and MM approach, they are simply asking us one question. If suppose TCS plans to sell its assets, it will get some value. Now, if TCS1 also plans to sell off its assets, will it get some different value as compared to this? No. They will say whether, you will realize that whether you sell off these assets or whether you sell off these assets, since both the assets are same, they cannot have two different values. So how you have arranged money? So suppose let's presume this TCS has raised full value of the funds by way of equity. TCS1 ने equity और debt दोनों raise किया है. तो we can say TCS becomes unlevered क्योंकि उसमें risk नहीं है, and TCS1 becomes levered क्योंकि उसमें debt है, financial risk है. So they simply argued that if the assets are the same, how it is financed, that is immaterial, because the value of the company is always a function of the value of its assets. So as per these two theories, these are which two theories? NOI and MM approach, it is the assets of the company which drive the value. But as per NI approach and traditional approach, it is always the liability side. That's the reason why they have always used in the formula V equals E plus D. But when we have to use NOI approach and MM approach, they have always will be using the formula as V equals EBIT by KO. So you arrange money in whichever manner, whichever pattern you want. As per NOI approach and MM approach, the value of the two companies will always be the same. So since values of the company will remain same, I can explain you this way. चलो अभी दोनों company का value कितना same ही रहेगा. If the assets of the two companies are same, can I say EBIT will also be same? Because if assets are the same, we'll generate the same sales. Same sales means same EBIT. Now EBIT same. value same, can I say KO has to be same? So you arrange money in whichever manner pattern you want. KO is unaffected because of pattern of arranging money. Whereas these people have completely different viewpoint. You just have to remember, friends, the first two approaches consider liabilities as a variant in determining the value of the firm. Whereas here, these two theories consider assets to be relevant in determining the value of the firm. Now, as I'm more interested in discussing this MM approach, so we can discuss this MM approach, and we have a couple of sums that are based on this MM approach that we can solve it. So let me take up the MM model or MM approach, and what is the basis for their argument. Let's understand that. Now, MM have actually favored NOI approach. The start itself is like this. MM have favored NOI approach. That is, even as per MM, the value of the company is always, value and KO of the company is always, independent to the pattern of arranging money. So as per MM, KO of the company is unaffected by a pattern of arranging this money. Now, how did they prove their point? This point they proved by carrying out a process which is called as arbitrage process. Now, what do you understand by the word arbitrage? Arbitrage is nothing but simultaneously carrying out two activities at a same time in order to make risk-free guaranteed profits. Sir, we did not understand this. What is this? Arbitrage is nothing but simultaneously carrying out two activities, either buying and then selling, or selling first and then covering up by buying it. And in this buying and selling simultaneously at two different places, if you make riskless profit, then that riskless profit is going to be termed as arbitrage profit, and the process is called arbitrage process. Now, how does this arbitrage works? Let's understand the same with the help of an example. My first question to you guys: can a product which is available at two different places, can it command two different prices? If I'm talking about this pen, now suppose let's presume we are in a place in Mumbai called Andheri, and there is one more place which is, say, Ghatkopar. Now, this pen is available at two places, Andheri, and it is available at Ghatkopar. Can this pen, which is identical in all aspects, manufactured by the same company, color same, ink same, everything about the company is the same, can this pen command two different prices? Now, many people will come out with saying an argument, yes sir, it will command two different prices. I would say theoretically it should not. Theoretically means in classroom and exam scenario. Theoretically it cannot and it should not command two different prices. If it commands two different prices, it means there is a defective pricing. Immediately arbitrageurs will participate and they will eliminate this defective pricing. Now how, sir? What are you telling us? Okay, let me explain this way. As I just told you that this pen is available, say, at Andheri for, say, rupees 100. Theoretically it should be available at 100 rupees only at Ghatkopar. You can't have different prices for the same pen. Suppose, but now at Ghatkopar it is available at rupees 50. So at Andheri it is available at 100, at Ghatkopar it is available at 50. Can I say there is a defective pricing? अच्छा, अगर defective pricing हुआ तो क्या होगा? Assume that there is unlimited demand and unlimited supply at both places, and assume that you are a rational human being. What would you do? You know what you would do? You would immediately buy the pen at Ghatkopar, come to Andheri and sell it for rupees 100, make risk-free profit of rupees 50. But then somebody would say, sir, क्या if ये 50 रुपया भी available नहीं होगा तो? So you can actually borrow money. So you borrow money from someone, say 50 rupees you borrow. For the sake of simplicity, let's presume we don't have any interest. We will borrow 50 rupees. So you borrow 50 rupees, buy the pen from Ghatkopar, come running to Andheri, sell it at 100, make risk-free profit of rupees 50. This risk-free profit is called arbitrage profits. Now, what will you think? अरे superb यार, इधर buy करो, इधर बेचो, ये buy करके इधर बेचने से profit होता है. So what will you do? You will definitely do this exercise. Now, the moment you realize that this situation is giving me a risk-free guaranteed profit, and the way you are smart, even others are smart, even others will also do the same thing. What they will do? They will also start buying the pen at Ghatkopar, start coming and they'll sell it at Andheri. Now, what will happen here? Since we are buying the pen at Ghatkopar, that means there is some seller here. What he will think now? Just think about his perception. वो बंदा क्या सोचेगा जो यहाँ पे पेन बेच रहा है? अरे अचानक इस पेन को क्या हो गया? Such a huge demand for this pen. So he will think this way. Let me check. He will tell, अरे 50 rupees I am not able to sell it here for 50. If you want, you guys can buy from me at rupees 60. आपका परसेप्शन अब क्या होगा? 60 ना, ठीक है ना, 60 तो 60, I'll buy at 60, I'll come and sell it here at rupees 100, make risk-free profit of rupees 40. So you will buy and you will come here. By the time you reach here, it means when you are selling the pen, that implies that there is one buyer here. एक बंदा तो है यहाँ पे खरीद रहा है. अब वो बंदा बोलता है, अरे अचानक क्या हो गया? There are so many sellers who are coming and selling this pen to me. Let me check. ये कौन सोच रहा है? यहाँ का buyer. Let me check. वो बोलेगा, अरे यार 100 rupees is very costly यार, नहीं परवड़ता है. आप लोगों को पेन बेचना है ना मुझे, तो आप 90 पे बेचो. तो what will you think? अरे ठीक है ना, 90 तो 90 मिल रहा है ना, 30 rupees तो मिल रहा है ना, और इसमें रिस्क क्या है? इधर बाय किया, इधर बेचा. Then you will again come to Ghatkopar and you will again do this exercise. But by the time you reach Ghatkopar, the person started asking for 70 rupees. He says, I will sell the pen if you give me 70 rupees. Again your perception will be what? ठीक है ना, मिल रहा है ना 20 रुपया. So you will buy at 70, you will come and sell it at 90. But by the time you reach here, this person says 80 rupees. Now what will you think? ठीक है, चलो अभी भी ठीक है, 10 rupees मिल रहा है. Now tell me, you will carry out this process of buying and selling till what time? Till the time that defective pricing is eliminated. That means till this buying and selling will continue the moment the product attains equilibrium value. That means suppose now this person starts saying 75 rupees pen and this also says I will also buy at 75. तो आप क्या सोचोगे? हैं, मरने दे, अभी क्या फायदा है? इधर जाके इधर बेचोगे तो कुछ नफा तो होने वाला है नहीं. So there's no point. So now but suppose here this person starts buying the pen at 70 rupees और यहाँ पे price 75 है, तो reverse arbitrage will start. So you will buy here and then you will sell here. So what is the point that I want to explain? A product cannot command two different prices. What if it commands two different prices? Then if it commands two different prices, there is defective pricing. And the moment there is defective pricing, arbitrageurs will participate and they will eliminate this defective pricing. They will start buying at a place where it is available at a cheaper rate, sell it at a higher rate, and they'll make risk-free guaranteed profits. That guaranteed profit is called arbitrage profit, and this process is called arbitrage process. The process of arbitrage stops when the product attains equilibrium value. So when the product attains equilibrium value, arbitrage will stop. Did you get this? So the point is what? A product cannot command two different prices. If it commands two different prices, It gives rise to earn arbitrage profit. People will simultaneously do two activities: buy at one place, sell it immediately at the next place, and then they can make risk-free profit, and that defective pricing will get eliminated. That defective pricing getting eliminated is going to be the equilibrium price. Okay, now do not get confused. Please do not get confused, because I'm going to change the product from pen to something else. So let's make the product now not as pen but a share of TCS. Now if I want to buy the share of this company TCS, could you please tell me from where can I get this? Now there is only one TCS. Huh? There are no two different companies. The share of the company TCS is, the company itself is one. It is available at two places. Since TCS is listed at two exchanges, one is the BSE and the other is NSE. So if I want to buy the share of TCS, I can get it either from NSE or I can even buy it from BSE. Now you think and tell me, can share of TCS command two different prices? Think. Can share of TCS command two different prices? No, definitely not. What if it commands two different prices? अभी company एक है, उसका share का दो भाव कैसे हो सकता है? So if company is the same, how can it have two different values? So if TCS has two different prices at two different places, what will happen? That is actually a defective pricing. It will give rise to earn arbitrage profit. People will grab that opportunity. They will eliminate the defective pricing. And the moment the defective pricing is eliminated, equilibrium price is attained and arbitrage will stop. So have used this concept of arbitrage and they have proved their point. Which point? That the companies cannot have two different values. So irrespective how you arrange money, the capital structure of the company doesn't affect the value and then the KO. And I'll explain you this way. In their example, what did they do? They took two companies. Let me take again the two companies. One is TCS and the other is TCS1. Now let's presume both companies have same level of assets. The only difference between TCS and TCS1 is TCS has raised entire money by way of equity, and here it's a combination of equity and debt. So since there is no debt here, there is no financial commitment. No financial commitment, it means there is no financial risk. So we can call it as unlevered. TCS1 has debt, so this is levered. Now simply argued one thing. When we have two companies which are identical in all aspects, their assets are the same. अगर ये कंपनी अपना assets मार्केट में जाके बेचेगा और अगर ये कंपनी assets मार्केट में जाके बेचेगा, तो क्या इनको different value मिलेगा? Will they get any different values? No, because assets are the same. If assets are the same, they cannot have two different values. Now if assets are the same, sales will remain same. If sales will remain same, so can I say till EBIT everything will remain same? Now if EBIT remains same, V remains same, can I say KO will remain same, because KO is nothing but EBIT by V. And it is proved that KO is completely independent on how you arrange money. It doesn't matter whether you arrange money by way of equity or by way of equity and debt, your KO will remain unchanged. Now then, when they were explaining this point, probably someone must have raised their hand saying, what if the values are different? What if the values of these two companies are different? Then argued that if they are having two different values, it means it would give rise to an arbitrage profit. People will exploit that opportunity and they will, exercise that option. They'll start the arbitrage process and soon that difference in the value will get eliminated. by the process of arbitrage. I will repeat. Theoretically, these two companies can, first of all, there will be no two such identical companies, but in their explanation, they have always taken that there are two companies which are ditto similar. Only difference between the two companies is in the pattern of arranging the money. How the money is arranged, that will never drive the value of the asset. So the assets ka value always will remain same, EBIT remaining same, KO will remain same. But then somebody from the crowd argued, what if both companies have different values? Then further plays their argument that when two companies have different values, then that means there would be an opportunity to earn arbitrage profits. People will grab that opportunity, and within split seconds of time, that difference in value will get eliminated. And the moment the difference in value gets eliminated, the companies will again attain equilibrium value. The moment they attain equilibrium value, EBIT remaining the same, KO has to be the same. Hence proved. Did you get this? So if I now ask you a question, don't jump to conclusion, friends. Think on your own and tell me. So as per if I want to make an equation here, as per what is their viewpoint? When a company has debt, that is value of levered company, tell me what is the viewpoint of value of levered company, that is a one which has debt, and value of unlevered company, that is one which is not having debt. आपको क्या लगता है, will the value of the two companies will be equal to each other or they will not be equal to each other? So what's the viewpoint? Will it be equal or it will not be equal to? It will be equal, and if it is not equal, that means it is giving rise to an arbitrage profits. People will grab that opportunity and they will definitely exercise that opportunity and they will eliminate the defective pricing. Is it okay? So this proposition is true. Further said, this is true, this is correct if there are no taxes. As per when two companies are identical, they cannot have two different values. If they have different values, it gives rise to an arbitrage profit. People will exploit that opportunity and the values of the two companies will become same. But this situation is true if and only if there are no taxes. So my dear friends, now tell me, if there are taxes, सोचने कहा, ये मैंने discuss किया है कहीं पे capital structure में. If there are taxes, then which company do you think will have an edge? Which company will be better off? Which company will have an edge over the other and why? If there are taxes, कौन सी कंपनी को benefit होगा and which company do you think will have an edge better off over the other? You would definitely realize that it is the levered company which will have an edge over unlevered. यानी कि value of levered company will be greater than the value of unlevered company. Sir, ऐसा क्यों? Why this will happen? Why, if there are taxes, why levered company's value will be greater than that of unlevered? Very simple reason. Levered company बोला तो कहने से उसमें डेट है. अच्छा, अगर डेट है तो कहने से डेट के वजह से इंटरेस्ट आएगा. अब उस इंटरेस्ट के पास, if there are taxes, due to the presence of this interest, कहने से company which is levered, that company would be able to save tax due to the presence of interest. So the value of levered company will be greater as compared to value of unlevered company due to presence of that interest. That interest is allowed as an expense. If it is allowed as an expense, it will reduce your taxable income. Thereby it will reduce your tax liability. So whatever tax liability will be getting reduced, it will increase the earnings of the equity shareholders and automatically the value of that company will go up. So whenever there are taxes, this company's worth will be greater than the value of the unlevered company. But by how much? So how do I calculate that? So I would say value of levered company will be equal to value of unlevered company. Can I say plus something? I will again repeat, if there are taxes, interest in this company which is levered, interest is considered to be an expense, it will reduce my taxable income, thereby it will reduce my tax liability. So we will save on that tax. The tax which we are going to save because of that interest will add value to this company. So it will add value by how much? So when I ask these questions in the classroom, people would say, sir, it will increase the value of the company by the amount of tax that we are going to save. And how do you calculate the tax savings due to interest? I have made you write also that tax savings due to anything is you take that expense, जिसके वजह से tax बच रहा है, you take that expense, just multiply it with tax rate, it is going to give you the tax savings. But friends, this will give you amount of tax that is getting saved. Is this going to be getting saved only for 1 year? No, it will be getting saved till the time that we have that debt in that capital structure. And nothing specified, we are always going to assume debt is irredeemable. I hope you remember that. Nothing specified, we are always going to assume debt is irredeemable. तो ये tax savings तो कहने से every year infinity तक चलेगा. But I am not interested in finding out tax savings due to interest. I want, तो ये जो बच रहा है tax, वो कितना value addition करेगा? How much value addition it is going to make to this company? So how do you find value, friends? Because of this savings in tax, value of the organization is going to rise. So how do I compute that? How did you get E? E कैसे मिला था? What's the way in which you calculated E? Can I say E was you took dividend, you capitalized it with KE to find value of equity. How did you get D? Interest, we capitalized it with KD to find the value of debt. So anything, if you want to find out value of anything, what you need to do? You need to capitalize that. तो ये जो interest है friends, can I say interest के वजह से जो tax बच रहा है, it is adding value. So how much value it is adding? I need to capitalize this. Now capitalize it with what? Should I capitalize it with KE, KD, KO? What do you think? Now this tax is getting saved because of what? Interest. Interest क्यों आ रहा है? Because of debt. So can I say the appropriate rate for capitalizing would be KD? Now if I simplify this formula, then I can again say value of levered company is going to be equal to value of unlevered company. अच्छा, when you take interest by KD, क्या मिलता है? Interest by KD is actually nothing but debt. That is what I discussed into tax rate. I will again repeat, when there are no taxes, दोनों companies का value same होगा. Different होगा, arbitrage same कर देगा. But this proposition is true only if there are no taxes. If there are taxes, interest in levered company will help the company to save tax. So that tax which the company is going to save due to that presence of interest, it will add value to the organization. How much? So what I did, I took first interest into the tax rate, but that interest into tax rate will give you the amount of tax which we are saving. I am not interested in finding out how much I am saving. I am interested in finding out that because of that savings, इसका value कितने से बढ़ेगा. So to find out that value increase, I will capitalize it. Now since this is getting saved because of debt, I'll capitalize it with KD, and once I do that, interest by KD is actually nothing but debt into tax rate. And if there are no taxes, again the original formula will prevail. See, value of levered is equal to unlevered. So that is what is the scenario here. Did you get that? I hope you followed this one. Now, if you get a sum in the exam that's going to be on MM approach, if you get a sum in the exam that is on MM approach or MM model, and if there are presence of taxes, then tell me which company's value would you find first? Would you find the value of levered company first, or would you find out the value of unlevered company if there are taxes? What's your opinion? You have to first find out value of unlevered company first, because value of levered company is dependent on unlevered plus something. Is it okay? So if there are taxes and if you have to find out value of the companies as per MM approach, ये equation सीधा लिखने का, पहले value of unlevered company ढूंढो, फिर levered company ढूंढोगे. Is it okay? So this was all about the MM approach and the MM model. We have two sums that are to be finished off of the MM approach, and that will finish it off. Okay, so now we have two sums that are there in respect of these MM hypothesis. So let's finish it off. Both being examination sum, I would suggest that you please do refer these two sums in your exams as well. So we have question number 7 now. Let's read question number 7. There are two firms P and Q which are identical except P does not use any debt in its capital structure, while Q has rupees 8 lakh 9% debentures in its capital structure. Both the firms have an EBIT of rupees 2,60,000 per annum and the capitalization rate is 10%. Now friends, how would you interpret this word capitalization rate? Can I say capitalization rate is nothing but KE. Whenever they use the word capitalization rate, you treat it as KE. Assuming a corporate tax of 30%, calculate the value of these firms according to MM hypothesis. Now, you just underline those statement, corporate tax of 30% and the value of these firms according to MM approach. Clearly, question ने बोला है कि find value of these two companies, and to find the value of these companies, we have to use MM model. And we also have the information about the tax rate. So I can say this way, as per MM approach, see whenever you get a sum on MM approach और वो बोलता है कि find value of this company, that company, सीधा एक statement लिख देने का, as per MM approach, if there are taxes. चलो chartered, tell me what's the formula. Value of levered company, value of levered company, can I say it will be equal to value of unlevered company plus debt times tax rate. This is the formula. You just write down this formula. Now, there are two companies which are identical in this sum. One is company P, the other is company Q. Tell me, between the two companies, which company is levered and which one is unlevered? चलो बोलो, दोनों में से कौन सी कंपनी में डेट है और कौन सी कंपनी में डेट नहीं है? You would realize P does not use any debt. It means I can say value of company P, it's an unlevered one. So value of company Q is equal to value of company P plus debt into tax rate. Now, I just told you that whenever in the question you have to find values of the companies using MM model, I would suggest that first we would target value of company P. So let us find out value of company P first. Now, under MM approach, how would you find V? Friends, V is always going to be equal to EBIT by KO. Under MM approach, V will always be calculated as EBIT by KO if there are no taxes. Check. In this sum, do we have any taxes? Yes, there are taxes. What's the tax rate given to be? The tax rate given is 30%. So it will be EBIT into 1 minus tax rate. I hope you remember this explanation. When I did the explanation, I told you KO is always after tax, EBIT is before tax. To eliminate that taxation difference, we take EBIT into 1 minus tax rate. So I am interested in finding out this value of company P. Check. Is EBIT available? Yes, it is 2,60,000. How much is the tax rate? 30%. That is what you guys said. So, okay, only I said that is going to be 30%. Now, in this case, how will I get the KO? If you notice, company P is unlevered. So can I say, since company P is unlevered, what can I make an argument? Can I say KO will be just equal to KE? When there is no debt in the capital structure, don't you think KO will be just equal to KE? So that's going to be equal to KE. And how much is this going to be? 10%. So we now have this as 10%. Now when you solve this, it's going to be 26 lakh into 1 minus 0.3. That's going to be 2,60,000 into 0.7 divided by 0.1. So that's giving me 18,20,000. So this becomes the value of the company 18,20,000. अब ये 18,20,000 मैं यहाँ पे लिख दूंगा. How much is the debt in company Q? In company Q, the debt, if you notice, is given to be rupees 8 lakh. So 8 lakh into 30% will give you the value of the tax savings due to that debt. So I would say plus 2,40,000. So we get the value 20,60,000. So this was a sum, and if I'm not mistaken, this was asked for 5 marks. Understand the risk reward. There's no risk at all. You could have finished off this sum in a max time of 3 to 4 minutes, provided your concepts are clear. So first I focused on this unlevered company. Since we are following approach, I will not take V equals E plus D. I would be taking V equals EBIT upon KO. EBIT is before tax, and since there are taxes, you will take EBIT as post-tax divided by KO. But KO of company P is not given. But doesn't matter, because any which ways company P is unlevered. So if it is unlevered, KO equals KE. So wo KO becomes KE, and then I'll consider it here. It gives me the value of the firm as 18,20,000. This is a value of company P. Use it here. It will give you value of company Q. If there were no taxes, then both the company's value would have been the same. Is it okay? So this was solution to question number 7. Please do refer this during your exam time, and the other one as well. That's question number 8. So let me discuss question number 8, and let's finish it off with question number 8. Okay, now that question number 8 was asked in the IPCC exams, and it was asked for 5 marks in compulsory section. Believe me, its worth should have been much more than 5 marks. It's not worth 5 marks. It should have been much more. Interesting sum it is. Let's read it. RES Limited is an all equity financed company. It has a market value of rupees 25 lakh and has cost of equity, that is KE, of 21%. Now, whenever you are going to come across the statement like this, company is all equity finance, you will be drawing 3 conclusions. दिमाग में सिर्फ 3 conclusions draw करो. Company is all equity. First, when it is all equity, it means it's an unlevered company. 2, KO will be equal to KE. 3, V will be just equal to E. Is it okay? Because there is no debt here. Now this company wants to buy back equity shares worth rupees 5 lakh by issuing and raising 15% perpetual debt of the same amount. Rate of tax may be taken as 30%. After capital restructuring and applying model with taxes. So underline that statement. After capital restructuring and applying model with taxes, you are required to calculate what? The market value of RES Limited, the cost of equity, the WACC, and then comment on it. Now, I'll explain you what is the stuff here first. Let us understand this question. Fantastic sum this is. Okay. First of all, check. this RES Limited, if you check at present, what is the scenario? If I prepare the balance sheet of RES Limited, they clearly have mentioned that the company is an all equity finance company. मतलब जितना भी पैसा उसने अरेंज किया है, it has been raised fully by way of equity. So this is assets here. Now, can I say we raise money so that we invest? We invest because that will help us to generate sales, and we generate sales so that we can generate EBIT, profits from the business. Now, what is the plan of this company? What is the plan of this company? The question says the company is all equity finance company. It has some value of rupees 25 lakh. It has KE of 21%. Now this company RES Limited is planning for some kind of capital structure, whereby it is planning to raise some 15% debt of rupees 5 lakh. And this borrowing which the company is going to do, what is the utility of this borrowing? What the company is going to do? This borrowing will be used to buy back equity. So they're planning to reduce equity of the organization. Now you guys think on your own and tell me, if the company is planning to raise this debt, is it going to be used to buy any new asset? No, it is going to be used to buy back equity. That means, can I say, assets of the company will continue to remain same? If assets of the company will continue to remain same, don't you think sales will remain same? And if sales will remain same, till EBIT, everything will remain same. Now, this is again the same company, RES Limited. This is also RES Limited. Now, what's the required part of the sum? Question says, after restructuring. Don't you think this is after restructuring? After restructuring, that is, this company becomes RES Limited after restructuring, that is after going for debt. And not only that, after restructuring, but also applying model with taxes, find the value of this company. So we have to find out how much is going to be V of RES Limited after restructuring. So can I call this as before restructuring? Now, if I go with the first required part of the sum, the question says find out value of RES Limited but after restructuring. This is the first point that I need to answer. But while finding out this value of RES Limited, I am supposed to use model. So as per model, I need to figure it out what's going to be the value. So friends, in model, if there are taxes, how do you find the value? As per if there are taxes, can we say value of levered company equals value of unlevered company plus debt into tax rate. Now, in the previous sum, that is company P and company Q, in that previous sum you would have realized that there were two companies. When I was discussing approach, I also took into the example two companies, TCS, TCS1. And in the example of there were two companies. But if you notice here, we have only one company. So then how will you find the value of RES Limited after restructuring? Tell me friends. Can I say this formula will still hold true? Because what they're actually asking us is find out value of RES Limited, which is going to be a levered company. After restructuring, the same company becomes levered. Don't you think value of RES Limited after restructuring, I'm using the word AR, that is going to be after restructuring. How will I get that friends? It is going to be value of the same company RES Limited but before restructuring, because before restructuring the same company was unlevered. After restructuring it becomes levered, plus debt into tax rate. Now, how much is the value of this RES Limited after restructuring? Check karo, check karo. It has already been given by the question. The market value of the organization is 25 lakh. So this I already know, it's 25 lakh. How much is the debt after restructuring? That's going to be 5 lakh rupees if I'm not mistaken. Yes, it is 5 lakh. But what about the tax rate, friends? Please check the tax rate. How much is the tax rate? The tax rate given is 30%. So if I now solve it, I can conclude that's going to be 25 lakh plus 1,50,000, and that's going to be 26,50,000. So this becomes the answer to the first point. You know, the whole crux part of this sum is these two balance sheets. If you understand the balance sheet before restructuring and after restructuring, then you can very well apply the formula of MM. I hope you guys have followed what has happened now. This becomes the answer to the first point. What is the second point that is being asked? They are asking us to calculate cost of equity. Now cost of equity, that is nothing but KE. And are we supposed to find out KE before restructuring or after restructuring? It is definitely after restructuring, because before restructuring the KE question nahi diya hai 21%. So we have to find out KE after restructuring. Wherever I am using the words AR, it is after restructuring, BR before restructuring. Tell me chartered, how will I get this KE? What is the formula? How will I get this KE? If you remember the formula for E, how do you get E? E, can I say, is capitalizing dividend with KE to find value of equity. So if I tell you, let's find out KE after restructuring, can I say that will be dividend, which should be after restructuring, by E, that also should be after restructuring. So if I can get dividend, which is after restructuring, and E after restructuring, I can get KE after restructuring. Take your time and think and tell me, between the two, what is possible for us to finish off first? What can we get first? Do you agree we can very well get E? How come, sir? How we can get E? I have already calculated V after restructuring. In this V, that is value of the entire firm, can I say that value of debt of 5 lakh is also incorporated? So if I remove the value of debt, what I'll be left with is value of equity. So I can say here, this is going to be 26,50,000 minus 5 lakh. So that will be 21,50,000, the value of equity, dividend. Now how will I get the dividend, and from where do I get the figure of dividend? Do you agree, friends? We will be able to find the level of dividends from the income statement. So we can very well prepare the income statement, and from the income statement we can get the value of dividend. So let's understand the calculation of dividend. So I want dividend after restructuring. So what I can do is I can start with EBIT. From that I can deduct interest. I can get the EBT less the tax, and if you remember, the resultant 100% payout ratio becomes dividend. अब मुझे ये dividend जो चाहिए वो एक dividend है. I want it to be after restructuring. Honestly tell me, in this entire income statement, what I can get सबसे fast? What is the first thing that I can get? Obviously interest, because I already have debt of rupees 5 lakh. Rate of interest being 15%, my amount here is going to be 75,000. So मुझे interest मिल गया. The applicable tax rate is 30%. So I already have the rate of tax. So I can apply the tax rate. But for applying the tax rate, I need EBT. And to get this EBT, I need EBIT. Now tell me chartered, from where do I get the figure of EBIT? मुझे EBIT कहाँ से मिलेगा? Tell me. EBIT. Look at the balance sheet. Look at the balance sheet. EBIT. Can I say before restructuring and after restructuring, since the assets of the company will continue to be the same, their sales will remain same, and if their sales will remain same till EBIT, everything will remain same. So don't you think before restructuring and after restructuring, the EBIT of the organization will remain same? So if I can somehow manage to get EBIT after restructuring, my job is done. Or rather, I would say this way, if I can somehow manage to get EBIT before restructuring, that itself will be EBIT after restructuring. So how do you think we can get EBIT after before restructuring? Now friends, can I say, since before restructuring company is unlevered, I can say V equals E and KO equals KE. Just for my purpose, satisfaction purpose, I'm just writing, this event happens. Acha, how do you calculate V, friends? Can I say, since there are taxes, V is going to be EBIT into 1 minus tax rate upon KO. KO becomes equal to KE. क्या मेरे पास EBIT है? अरे वही तो ढूंढना है. अच्छा, क्या मेरे पास V है before restructuring? Yes. How much it is? 25 lakh. Already I know this is 25 lakh. EBIT is what I don't know. I know the tax rate, that's 30%, so 1 minus 0.3. KO. KO. Can I say before restructuring KO equals KE 21%. So this will be 0.21. So if you solve this, it will give you EBIT of the organization before restructuring. Please do solve it for me. So I think that's going to be 25 lakh into 0.21 divided by 0.7. That's coming to 7.5 lakh rupees. तो ये 7,50,000 का हम क्या करें? This 7,50,000 I'll straight away dump it here. 7,50,000. Subtract the interest of 75,000. This will give me 6,75,000. Apply the tax rate. So that's going to be 2,02,500. Subtract the tax. 472,500 is going to be the dividend. But my dear friends, what's the point of calculating this dividend? The objective with which I have calculated the dividend is to get KE. तो ये 472,500 हम यहाँ लिख देंगे. तो 472,500 divided by 21,50,000. That's going to give me the KE. So 472,500 divided by 21,50,000. So that's going to give me 0.2198, which is actually nothing but 21.98%. Did you get that? So that's going to be my KE. So two things I have calculated: value of RES Limited, cost of equity, that is KE after restructuring. There is one more thing that needs to be computed, and the thing that is to be computed is the WACC. Now meanwhile, in case if you haven't copied this thing, so I would suggest first, because I'll have to erase the stuff on the board, so just take a snap of this and then I'll solve the third part. Okay, so now let me finish off the third and the last point, that is computing the weighted average cost of capital, and then we can comment on it. Okay, so for that I would simply erase this balance sheet now, because you already have this balance sheet in front of you now, as you have already taken a snapshot. The entire solution now you have it except for the last one. So let's compute the WACC, friends, and then we can give a commentary on it. So let's understand the weighted average cost of capital. Now, do I want the WACC to be before restructuring or after restructuring? Everything, friends, here needed is after restructuring. So I can say this is going to be like my third and the final point of discussion. We want WACC after restructuring. Friends, tell me, how do we compute this WACC? Since the start of this chapter, I am telling you that whenever we have to calculate WACC, we always have to prepare a table. The table will have how many columns? 5 columns. So we will have sources, then we will have amounts, weights, cost in percent, weights times cost gives me the WACC. Now after restructuring, if you just look at the balance sheet again that is there with you guys, after restructuring there will be only two sources. One is debt, the other is equity. Between book values and the market values, we are going to give preference to the market values. Now can I say after restructuring पूरे enterprise का value 26,50,000 होगा. Value of RES Limited after restructuring is 25,60,000. उसमें से equity का value मिल गया 21,50,000. So that's going to be 21,50,000. And can I say debt here is going to be rupees 5 lakh. Now I'll calculate the weights. So we will now assign the weights. So 26,50,000 is the worth of the company. So 5 lakh divided by 26,50,000. So that's giving me 0.19. So this becomes 0.81. Now the moment I have these weights, then I can use these values and I can calculate the cost in percentage. अच्छा, equity का तो KE हमने already ढूंढ लिया है. That itself is the second required part. Calculate the cost of equity. That's going to be KE. So this we already know. It's 21.98. If I can get KD, then my job is done. Now tell me chartered, how would you get KD? Same thing. KD, redeemable, irredeemable. Clearly mentioned it is perpetual, so it is irredeemable. Fresh issue or existing, company is planning to raise a fresh debt of rupees 5 lakh to buy back equity. So can I say this is KE fresh, that is we can say new. So KE here would be new, KD rather, and then this would be interest into 1 minus the tax rate by what? Market value or net proceeds? Net proceeds into 100. Achha, how much proceeds are we going to get by issuing this debt? 5 lakh rupees. There are no flotation costs, so that can be ignored. Interest at 15% was 75,000. Applicable tax rate is 30%, so 1 minus 0.3 into 100. So how much is this coming to? Please check. So 75,000 into 0.7 divided by 5 lakh percent. So that's 10.5%. Up this 10.5% can be straight away dumped here, and then some of the products of weights and cost will give me the WACC, that is KO after restructuring. So we say 0.19 into 10.5, 0.81 into 21.98, and then we can say the grand total is 19.80%. That's going to be my KO. So they have asked us to calculate WACC after restructuring, and we have calculated the WACC after restructuring. If I tell you, give me the comment on it, what commentary you will write? The commentary would be like this. Before restructuring, our KO was 21%. Before restructuring, our KO was 20%, which has now reduced to 19.8%. So you would have realized that KO will come down after taking the debt. And the reason for that is only because of one thing, that's because of tax getting saved due to presence of that debt. There is no other reason. So our overall cost of capital will come down from 21% to 19.8%. So if you have to write a commentary, your commentary would be, after restructuring, the overall cost of capital of the company will come down from 21% to 19.8% due to the capital restructuring. Now this was approach. I have taken up two sums, selected sums, which are past examination sum. Possibilities are always there. The same questions can get repeated, and both being of approach, I thought it would be appropriate to solve these two sums. And with this I can say the entire chapter of cost of capital I have covered it up with the important sums as well and important concepts. So if you recollect, I'll just give you a brief overview. We discussed meaning, we discussed objective. Objective was to get cutoff, that is KO. To get that KO we required KD, KP, KE, KR. We discussed first KD, then we realized that can be redeemable, it could be irredeemable. So we have separate formulas for KD being redeemable, irredeemable. Same was applied for KP, redeemable, irredeemable. Then we discussed KE. There were 6 approaches for calculating KE that we discussed. Unless specified, KR will be just taken up as good as KE. Now once that was done, Then we discuss what are the different types of weights that are possible. What are the different types of weights? The book value weights, the market value weights, the marginal value weights. If the funds are existing funds, then either you will be following book value weights or market value weights. No information given, then we would prefer market value weights. If these are new funds and if you have to find out KO for new funds, additional funds or a new project, we go for marginal value weights. After discussing that, thereafter we discussed how is growth rate to be calculated. So we learned calculation of growth rate. You can check past track record of the dividend. If track record is given, you can use that and you can calculate the growth rate. If 2 years data of dividend is given, in between data missing, you can use compound interest formula. Then we have one more formula for calculating growth rate, that's going to be G equals B into R. Alternatively, you can get G equals EPS minus DPS by book value per share. Now if suppose book value per share is not given, book value, between book and market values we give preference to market values. So if suppose book value per share is not given, then in that case you could have changed the formula to EPS minus DPS by MPS. So that was growth rate. Thereafter we discussed these capital structure theories. I have selected MM approach, and MM are of the opinion that when two companies are same, identical, they cannot have two different values. If they have two different values, then there is an opportunity to earn arbitrage profits, and soon the values of the two companies will become equal due to the arbitrage, which leads us to conclusion that value of levered equals unlevered if there are no taxes. If there are taxes, value of levered company equals unlevered plus debt into tax rate. So this was whole about cost of capital, and with this we end the chapter of cost of capital. Thank you.